Well, it's a great question, and I think really what people are trying to understand, there's a lot of pieces moving around here, and our focus is really here on valuation. That's really where the biggest distortions were at the beginning of the year. We started with a 21.5 multiple. We're down to a 16.5. That's roughly in line with long-term averages. But more importantly, expensive companies were extremely expensive, and that's where all the pain has been. You see that in secular growth themes. You see that in technology, communications. When you look outside of those groups, valuations look a lot more reasonable. The pain looks a lot less meaningful in those groups. This has been a valuation re-rating because of higher interest rates, and that's a meaningful part of the discussion.
Which sounds all very logical, and it's easy to then come on and say, look, if I like those stocks before, they've been on sale, let's buy them. But it doesn't count for the behavior of investors who see their statements and say, holy cow, we've got to get rid of this. We've got to actually start selling. We haven't seen those kinds of mass sales. How much of an overshoot to the downside could we see before we get to what you expect to be a rally?
Well, I think we're pretty much getting close to that bottom now. Like we've highlighted earlier in the show, 20% right now is really where the S&P is down. Historically, in bear markets, we see it down a little bit more, but that tends to be recessionary. Right now, we have an incredibly strong economic outlook. Certainly, inflation is a concern, and I agree with that. But right now, nominally, GDP is expected to be 9% this year, with real GDP being 3%. That doesn't feel recessionary to me.
This is really important, folks, what you're hearing here, this nominal versus real argument. Patrick, let's say we've got a nominal glide path. I'm going to call it harmonic. You go from 9%, as you state, to 4.5%. Maybe we get down to 2.25% at some point, Japan-like. But within that time frame, corporations adjust, and they adjust use of cash. What do you, as optimists, feel use of cash will be starting now, into the summer, and into the budget outlook the corporations frame for 2023?
Well, companies are always very rational with how they deploy their capital. Right now, we've seen shifts towards dividends. We've seen increasingly shifts towards buybacks. We've also seen a shift towards CapEx. I think all three of those areas are going to continue to see growth. We're seeing areas like dividends and CapEx get rewarded a lot more than buybacks. So companies shifting that way are going to likely see better returns than perhaps going directly towards buybacks. But there's ample capital on many of these companies, particularly large cap companies, given how strong free cash flow is, and we expect them to continue to use that.
Well, a ruder way to ask Tom's question is, are they going to start to lay off people in order to save costs, in order to increase their margins, especially as you get the likes of Amazon and Walmart talking about how basically they have too many people paid too much based on the shift in appetite by consumers?
Well, I think as long as the demand is there, companies are staffing to meet the level of demand. They're not staffing to meet stock market gyrations. So yes, the market's down, and I think investors are assuming that's going to impact companies' decisions. But a company doesn't say, I'm not going to meet your order because my stock is up 20%. They say, no, you want an order, I'm going to supply you with that order. Depending on how much demand declines from here, that's ultimately going to depend on how much staffing they need. Right now, the GDP backdrop still remains quite robust. Labor market remains incredibly tight. Does that weaken incrementally? Perhaps. But I don't see that as being a huge catalyst in the story here. As
Patrick, just to jump in, because I think this is really important. I know that companies don't base what they need to supply the company with based on what's happening with the equity market, but I would say some of the C-suite right now, they are worse at calling their own company than some people are on this show calling this market. And that's been the problem. These companies have set themselves up for the demand of last year, and it's not there anymore. We saw that with Target. We saw that with Walmart. We saw it with Amazon. Patrick, we've got some stuff to work through here. Don't you agree?
I do think we agree, and I think there's areas of the market that are particularly under pressure. Discretionary is an area that's probably going to be weaker. I think technology is an area that's going to be weaker as well. I think investors need to be selective in where they look at the opportunities for companies. I mean, we're investing, we're encouraging investors to look at cyclical-oriented companies like energy, materials, industrials, things that benefit more from this backdrop and are less exposed to some of the issues that are happening perhaps with technology and with some of the issues with the consumer at the moment.
Great to catch up, Patrick. As always, to get your view, your perspective. And send our best to Jonathan as well. Patrick Palfrey there of Credit Suisse. Very difficult, Tom, to find the right balance in this economy right now.
You got to find the right belief. This is where your belief structure, John, matters. You have to have an outlook. You have to have, I mean, I make jokes about the triple leveraged all cash fund. And John, I am considering, somebody asked, are you going to fourple leveraged? And I said, it's under discussion right now with my advisors. But John, critically important, you've got to have a belief structure which starts with economics and then, frankly, as you heard from Mr. Palfrey, forces its way into corporations and their financial decisions.
And it looks like some of these corporations made a very bad call last year. Let's work through it. You saw it with Target, with Walmart, with Amazon. There's no air about it. Carry on making that noise. They built out capacity aggressively. They got all the staff back. Tom, they built up inventory, supply, all of that stuff. And look where we are. Look what's happened with Peloton, with Target, with Walmart, with Amazon. There's too much capacity, Tom. They've told you that on the call.
They, and you're right, they and all of us are making it up as we go out of a pandemic. And the optimism I would have, John, is they will rapidly right-size off of the shock of what we've seen the last 2 days.
Lisa, everyone was
hoping
hoping
at light speed
for a supply-side recovery. What's happened is that demand is taking over. And that's what we're hearing. I mean, I'm not an economist. I'm not trying to be one. I just listen to what the companies are telling you, and that is what they're telling you right now.
And frankly, this has been the issue. You've been looking for a supply-side response that has not come because of what's going on in China with the lockdowns there and the Ukrainian war. You're looking for all of the workers to come back into the market, but which workers and to what jobs? And all of a sudden, you have these structures of the corporations paying that much more to individuals at a time when the consumer appetite is changing at light speed. How do they maneuver, John, even with nominal growth, even if you strip out the concept of inflation?
Equity futures on the S&P down 1.3%, on the Nasdaq 100 down by 1.4. Coming up, we'll catch up with an economist, a brilliant one, Claudia Sam, the Director of Macroeconomic Research at the Jane Family Institute. Joining us next on this program with Tom Keene, Lisa Abramowitz and Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. There's a sign that Beijing is strengthening its energy ties with Moscow, just as Europe turns towards banning imports. Bloomberg has learned that China wants to replenish its strategic oil stockpiles with cheap crude from Russia. The strategic reserves are tapped during times of emergencies or sudden disruptions. President Biden meets today with the leaders of Finland and Sweden to discuss their bids to join NATO. Turkey's President Recep Tayyip Erdogan is opposed to the move because of the two countries' stance on Kurdish militants he considers terrorists. Turkey called on NATO members to do more to address its security concerns. In London, police have wrapped up their high-profile Partygate investigation that caught Prime Minister Boris Johnson. More than 126 fines have been issued over COVID rule-breaking parties held at Downing Street during lockdown. None of those fines was identified. British Airways owner IAG has agreed to buy 50 Boeing 737 MAX jets. That's a lift to the struggling plane maker, and it concludes a widely watched commitment for 200 aircraft that was reached 3 years ago. The 50 planes have a list price of about $60 billion, but IAG says it's negotiated a substantial discount. Gabe Plotkin is shutting down his $7.8 billion hedge fund, Melvin Capital Management. More than a year ago, the fund was grievously injured in a GameStop short squeeze by amateur traders who organized on Reddit. It never recovered. A comeback effort showed initial promise, but unraveled in recent weeks. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Going forward, if there are no significant changes in the data in the coming weeks, I expect 2 additional 50 basis point rate hikes in June and July.
Nothing's changed for them just yet. That was Patrick Harker, the Philadelphia Fed president, speaking in the last 24 hours. Live from New York City this morning. Good morning. Equity futures shaping up as follows. I'm afraid to say for the equity bulls, more pain ahead, perhaps. Equity futures down by more than 1% on the S&P, down by 1.2 on the NASDAQ. The good news, we're off session lows, and I have absolutely no idea if we'll be in the same place in about 5 minutes' time. Yields lower by 6 basis points on a 10-year, 282.62. Yields lower, treasuries firmer, and in the FX market, Tom, the dollar a whole lot weaker, euro dollar 105.23. That currency pair firmer, positive by about 5 or 0.6%.
Continue to monitor a better tape right now, John. Dow futures negative 338 off of negative 400 earlier. I'm going to call it, John, what, an easing here in the last 20 minutes?
A little bit, Tom, but it's hard to read into it, isn't it? How many times have we been caught offside over the last couple of months? 6:48
Wall Street time. We welcome all of you on radio and television. She created a firestorm in her last appearance with us. Claudia Sahm is cooled off. She's director of macroeconomic research at Jane Family Institute. Claudia, it's amazing and sad how I remember papers from years ago. And I remember a guy named Mankiw at a small school on the East Coast writing with a kid who looked like he was 16 named Justin Wolfers. And they wrote a paper, Disagreement About Inflation Expectations, 20 years ago. Nothing's changed. We've got disagreement right now about inflation expectations. Claudia, if we get a growth slowdown, do we disinflate?
Well, we're going to, as growth slows, and we have room to slow. Like, we are experiencing really fast growth right now. And yeah, prices, the rate of increases in prices, inflation is going to step down. Now, it's a big question how quickly consumers, stop going out and buying more and more. And that means it's a question how slow or how fast or how slowly inflation starts stepping down. There's a lot of factors, but I mean, supply and demand make
There
prices,
we go.
right?
Sam, Professor Sam, killing it with her For those of you on radio, you just missed the famous Sam Marshallian cross. She absolutely nailed that. Claudia, I see two things right now. John's been great about giving us the equity gyrations and Lisa the bond gyration. I see the financial conditions once again tightening up. The Bloomberg Financial Conditions Index goes down. It's not through the new lows, but it's getting there quickly. Does the market do the work for the Fed so that we completely have wrong our parlor game of Fed guessing out 1 year?
Yeah, so the heavy lifting is going to be done by the American consumers, right? They're the ones deciding, do we rotate back from goods to services? Do we slow it down a little bit in terms of the shopping? And part of that, I mean, like, people do look at their wealth and decide I can spend out of it, or I feel comfortable spending because I know I got a little back on the side. But frankly, it's income. Income is the big determinant of spending for the vast majority of Americans. So yeah, I mean, the wealth effect stock market comes down. That takes a little bit of pressure off consumer spending. The Fed is looking for this. I mean, they ain't going to say, yay, the stock market is down, but it does move in that quote unquote financial conditions, but it is not enough to really move the needle in terms of demand and then of inflation.
Especially because the consumer right now, even if their incomes are not keeping up with inflation, are still borrowing an increasing amount of money. They have traditionally been under-levered over the past year or 2 years, and we're hearing from a growing number of economists and analysts. They are starting to borrow again to support their spending, even as the stimulus checks run off and their incomes don't keep pace. Does that concern you? Should it concern the Fed and get them moving faster to get ahead of that?
Well, I think we need to keep in mind that during the pandemic, the 2020, in a very unusual way, debt went down, debt relative to income. I mean, the people were not spending, they were being able to pay off debt. This is so not common in a recession. So in some ways, we're getting back to normal. But I will say we still, there's clear evidence that households, including lower income, lower wealth households, that they have built up a little bit of a buffer, and also very unusual to past recessions. But yeah, the Fed needs to see it cool down some.
So when you talk about unusual versus past recessions, you're kind of going toward the elephant in the room, which is the stimulus plan. An increasing number of politicians have been blaming the Biden administration for going ahead with the additional round of checks. In March of 2021, when we were emerging from the pandemic and the whole idea of how big was this, how much too big, and how much is this really fueling the inflation that we're seeing, can you give us a sense of where you question your own beliefs on this front? I know that you think it was important to give those stimulus checks out to the people. Where do you question the methodology that was executed?
Right. Well, I've written recently that one thing we can do for next time is tie the stimulus to economic conditions. Like, the last check should not have been the biggest check, right? But it was very political. Then President Trump just pulled $2,000, out in thin air. So we can do better, but I remain convinced, and we will learn this as we go forward, that that last stimulus gave us a cushion in a way that other countries did not get, and this could easily be the difference between us not going into a recession and other parts of the world going into it. Like, we've got a little bit of a buffer. But it also absolutely contributed to inflation.
Claudia, did you just blame President Trump for a bill that President Biden passed?
Well, like the flag was planted, right? It was,
Come
and
on,
again,
Claudia.
No, I'm serious. It was very instrumental in the Georgia runoffs, for example, right? Like, they didn't, early on, the Democrats could have said, no, 2,000's too much. And there were, frankly, some Democratic advisors who were saying that very clearly at the end of this year. But to me, it's like $2,000 was better than $0. right? And so, and it's not, absolutely not the only contributor to inflation. The inflation that's got a lot of Americans really hurting and angry is food and gas. And like, that ain't the rescue plan, right? We're seeing that inflation hit Europe particularly hard. I mean, that's related to Putin's invasion of the Ukraine, but like, we were gonna have higher prices anyways, and the rescue plan gave Americans a little bit of a buffer.
Claudia, Sam, thank you, as always, from the Jane Family Institute. Looking back over the last 18 months, Tom, difficult to look back and come up with an idea that gets everyone to agree with it. But right now, Tom, we've got a problem. And right now, politically speaking, the White House has got to try and deal with it ahead of the midterms.
As you mentioned earlier, John, and I really, and this is something, folks, it's the hallmark of Bloomberg surveillance. We refuse to go narrow. We refuse to just focus on the stock market and the rest. The set of risks now, John. I just looked, John, thank you, Javier Blas, at Australian coal, Newcastle coal. John, never before have we seen what we see in coal shipped out of Australia north.
I mean, I've never seen a guest come on the program, Tom, and blame the former president for a bill the current president
Well,
signed.
that's the politics of it, and Dr. Sam is in the heart of the politics.
Getting ridiculous. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What we're seeing this quarter is that consumers pushing back. They're saying you can't raise prices.
Inflation, it's high. It's not going to be back to the 2% target anytime soon.
The overwhelming urge, as Jerome Powell stated yesterday, to continue to fight inflation can create a reasonable amount of volatility.
If anything, the risk is that they raise more than what you see priced in the market right now.
We still put the possibility of a recession by end of 2023 at around 30%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a moment for this market. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures down about 1% on the S&P. On the Nasdaq TK, we're down 1%. Also, the good news, we're off session lows.
We're off session lows of an hour and a half, 90 minutes ago as well, John, but it continues on here. And what it is a massive recalibration across what we do, economics, finance, and investment. And I got to admit, the chit-chat, just as we have with Claudia Sahm, is going to start with economics. John, what does any given central bank do, given the cards dealt in the last 48 hours?
Well, if you're listening to Chairman Powell, Tom, you keep on hiking. And I imagine there's a relationship there between what he's saying and what's happening with this market. Deutsche Bank saying overnight, Tom, we are at the recession crossroads for this market. Near term at 36.50, and then the range of outcomes is wide, wide, wide.
We've never seen this, and particularly, John, I sound like a broken record. John, a record is a thing that spins around and you put a needle on it. John, a broken record, the bond market is leading the way. We're seeing real carnage in the bond market, and I'm sorry, the central banks, in some way, facing warm.
Would you like me to count you in? I can do it. Would you like me to count you in?
Yeah,
3, 2, 1.
Face-saving form. Nice cue.
No, that was beautiful,
Nailed it.
Tom.
And what's important here, John, is they're going to blink, they're going to adjust, they're going to adapt.
Hey, that's what you think, Tom. But right now, in this market, they're worried that the Fed won't. And that's why we're seeing some of this price action evolve. Lisa, exacerbating the trend yesterday, the retail numbers, it's all stacking up from Amazon to Target to Walmart, and now Kohl's
coming out actually with their expectation of a much lower multiple coming out, expecting full year adjusted EPS of $6.45 to $6.85 from the $7 to $7.50 that they had previously expected. Also with earnings per share coming in well below where people had expected it for the first quarter at 11 cents versus the estimate of 71 cents. How much is this a repeat, a redux of what we saw in Walmart and Target? How much are we looking as Kohl's shares tank pre-market, down more than 6% right now? How much are we looking at consumers pushing back, not buying goods because of the high prices as they transfer their money to other areas, and frankly, CEOs that have not prepared for this?
Well, it was down 11% yesterday. It's down another 6%.
I know, exactly.
In early trading.
Carnage.
Retail got hammered over the last couple of days. Lisa, finding the right balance in the C-suite right now is clearly something they're all struggling to do. Going from this really strong positive demand shock of the last 18 months, they tried to ramp up capacity, tried to get the supplies in, build out inventory, and they arrive in 2022 facing a very different moment.
And right now, this is about margin compression, right? Because what we're seeing is that the revenues, the nominal sales are coming in strong. This sort of speaks to the point that Tom was saying before. There is more money in the system. People are spending it. The actual revenue in the first quarter was above where the consensus thought it would be at $3.72 billion versus $3.68 billion that was expected. This really speaks to the costs that they have to manage. How do they manage those? And how does that bleed into sentiment?
TK, what a moment to be a CEO.
Well, to be a CEO or portfolio manager, I think everybody's aging. John, this is the way it's going to work. It always, always, always works this way. You do late summer, autumn planning into 2023, codified on Wall Street into February bonus. Other corporations are different. All of that, John, with a vengeance, is going to be pulled forward into June.
Let's whip through this price action. We are down about 1% on the S&P. Yesterday was ugly. Some negative follow-through on the Nasdaq 100. We're down by more than 1 full percentage point. To the listeners out there, Dale writes in, you would have been proud of my kid this morning. The Dow Jones plunges this morning. No one cares about the Dow Jones. Bramo, that from a 12-year-old listening to Bloomberg Surveillance this morning.
I love that they're giving you pep talks with their children as they talk about the Dow. Okay, well, it's a life that some of us do have as well at home. All right, today, those retail earnings very much front and center. Kohl's, as we were just talking about, just reporting. And this follows Target's carnage yesterday, down more than 25%. The biggest drop in those shares going back to 1987. Walmart with a similar trend the day before. How much is this a story of margins? Yes, on a nominal basis, people are spending more money because things cost that much more, but that is not translating into profit. And how do they square that, given the fact that they're paying so much more for labor, for the materials, and frankly, compensating for a disruption in what people are buying at a pace that we have never seen before? Today, economic data includes U.S. initial jobless claims at 8:30 a.m. and April existing home sales. I am watching the mix of potential job cuts because this really speaks to how different companies are right-sizing. What about the builders? That is where we have started to see weakness because housing, frankly, has started to show signs of being a little bit nervous in the face of interest rates that are so high, mortgage rates that are so high, and the material costs that also are so high. And what you're seeing is that a potential rollover in the number of construction workers could portend further weakness in the U.S. economy. And meanwhile, today, President Biden is focusing on alliances of all types. We have Sweden and Finland's heads coming to the White House this morning and talk about how they're going to make a bid for NATO. I'm sure Turkey will be a big discussion as a sticking point and what they're willing to give. And then President Biden is heading to Asia for the Indo-Pacific Economic Framework. John, we are talking about one geopolitical crisis to another. How do you account for some sort of disruption in Taiwan as China really comes out and says that what the U.S. is doing in terms of rhetoric is starting to get a little bit dangerous to them?
I can't even get there. Honestly, I just can't even get there.
I know, which is the reason why people aren't talking about it.
It's so hard to even focus on an additional thing right now, Tom.
That is exactly right.
Given everything that's happening.
Well said. The only one on the planet that's going to care about this trip is Anne-Marie Horton, and what the hell does she know?
We'll catch up with AMH a little bit later. Laurie Heinel joins us now, Global Chief Investment Officer of State Street Global Advisors. Laurie, you've got that big cash position. You can talk to us about how big that is. What are you waiting for to deploy it?
Well, first of all, there's a lot of uncertainty out there. So I would say the biggest theme around our portfolios right now is less about the directional trade and much more about the relative value. So we've been trading around different markets, deploying capital into the U.S., which we thought was still a bit of a safe haven relative to other regions, but also looking at places like commodities, looking at places like gold, and as you say, holding a bit of a 5% cash position right now.
Laurie, you are the perfect one to talk about right now. And folks, this is the esteemed chairman of Bloomberg, Peter T. Grauer, telling me in times of stress, you see transactions and combinations. Kohl's is flat on their back. They have just announced, within all the troubles of Kohl's over decades, board thoroughly testing standalone strategic plan. Are we going to see one big roll-up, Laurie, of American finance and corporations out of these risks and challenges?
Well, every situation is idiosyncratic. And one of the things that's striking about the recent announcements on the consumer side is that we've known for a while that consumers were likely to move from more goods-oriented purchases to more service-oriented purchases. And while we certainly have had some of the news out on some of those retail franchises, the other side of it is you've got airlines and other service providers that are actually seeing very good demand and actually having some pricing power. So it's not just a one-size-fits-all. There's going to be a lot of idiosyncratic behavior, and companies that can think about what their exposures are and how to hedge those and where they do have pricing flexibility or power, those are the ones that are going to survive.
I can't emphasize, Lisa, enough the need here to be one size is wrong. Target, 450,000 employees. Kohl's, 35,000, and yet people like to compare the two. They're completely different, including a 10-year total return. Target gets it. Kohl's has been a disaster.
Right, and we can talk more about the two distinct stories, but they're responding to the same macroeconomic backdrop. And Laurie, when you take a look at this multifaceted backdrop that is not just one narrative, what gives you conviction that, frankly, the market is right, that the Fed is going to blink well before it raises rates to restrictive territory, which seems to be the zeitgeist right now in markets?
Well, the big conundrum, as we've talked about, and I've heard you talking about this morning as well, is that on the one hand, we still have inflation, which we could argue whether we've hit peak inflation or not, but the numbers are still quite eye-popping. We all know that eventually that wears itself out because the comps year over year get harder and harder. But that's happening at the same time that growth from a macro standpoint is slowing. And so this delicate balancing act is what the Fed's got to navigate, what all central bankers have to navigate. And everybody's afraid that they're going to get it wrong. And the chances are that they will get it wrong. We actually are a little bit more dovish in terms of what we think the Fed's going to do. And if they move in the summer and then actually do take a bit of a pause, then there's a chance that we get out of this without a recession.
Laurie, thank you for your perspective, as always. Laurie Heinel there of State Street Global Advisors. That is the consensus on the street right now. You can push back, agree with it, disagree with it, do what you want with it, but that is the consensus on the street right now. The near term, this is going to be messy, but long term, we get a relief rally year end, because many people believe, Tom, like you, that we get to the end of the summer, the Fed reassesses and takes a step back from what it's doing.
Well, that's the catharsis story. It's a 32.27, John, in the VIX. Okay, there's a lot of agony out there. Maybe, John, things get worse. We get up to 38 or 40 VIX. My point is institutions adapt and adjust. I mean, John Stolfus coming up will tell you the same thing. These corporations, John, just like Kohl's, which has been a 20-year train wreck, Kohl's is going to adapt and adjust to what they've been handed.
The risk is when things like this happen, and we talk about this often, going back to the work of Soros, Popper, etc. Tom, you know it well. Markets can shape the events they anticipate. Deutsche Bank and Big Charter talked about this, that some of this, Tom, can become self-fulfilling if financial conditions tighten too much.
No question about that. Bill Gross is actually very, very good about that over different cycles. You do get a circuitous nature, John, that you've got to be very aware of, and you particularly see that in bonds where price down is like, never have we seen this. And the answer is, as Lisa knows better than me, spreads are actually well contained.
Spreads just about starting to break out now, though, Lisa. Where are we at now? Pushing 500, 470, 480?
Yeah, to the highest levels going back to May of 2020 in the high yield space. How much does this start to get people's attention? Not so much quite yet, but it's starting. And this is really what perhaps the Fed will blink at. It's not going to be stocks.
It's on the radar. It's certainly on the radar. Futures down by 1.2% on the S&P. On the NASDAQ, down by a little bit more. From New York City, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. China's top diplomat has again warned the U.S. about its increased support for Taiwan. In a phone call with National Security Advisor Jake Sullivan, Yang Jiechi said the U.S. is going down the wrong road and that could lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. And there is a sign that Beijing is strengthening its energy ties with Moscow just as Europe turns towards banning imports. Bloomberg has learned that China wants to replenish its strategic oil stockpiles with cheap crude from Russia. The strategic reserves are tapped during times of emergencies or sudden disruptions. And the world's richest person saw his wealth shrink by more than $12 billion in one day. Tesla fell to the lowest level this year, knocking Elon Musk's fortune down below $210 billion. Musk has lost $49 billion since launching his bid for Twitter last month. Part of that is due to the wider market sell-off. Plus, investors in Tesla are concerned about how Musk will fund that Twitter bid. And President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. Gabe Plotkin is shutting down his $7.8 billion hedge fund, Melvin Capital Management. More than a year ago, the fund was grievously injured in a GameStop short squeeze by amateur traders who organized on Reddit. It never recovered. A comeback effort showed initial promise, but unraveled in recent weeks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
best of financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
We feel responsible for the capability of the Ukrainian state and its people to defend themselves. We see a number of double-digit billion euros which are needed for the foreseeable future of the next months.
The Europeans are in a tough spot right now, that's for sure. Christian Lindner, the German finance minister from New York City this morning. Good morning. This is Bloomberg Surveillance. The negative follow-through looks like this in the equity market. The S&P is down by more than 1%. The Nasdaq is down by 1.2. Treasuries are rallying again. Yields are lower by 5 or 6 basis points. And there's the move on crude, Tom. 107.65 on WTI. We're down about 1.8%.
Yeah, I mean, there it is. And right now, Brent is fractionally pennies above where West Texas Intermediate is, but it's got its own gyration, and we're focused, as Lisa's mentioned, on the distillate market, which is what you do with the oil when you go through the refinery process. We're going to stagger forward here. Mark Champion joins us now in Glasgow, and also Jack Fitzpatrick in Washington. Mark, let me go to you. I was rude and spent way too much time with Fitzpatrick in Washington the last go around. Mark, I think that the grinding news of the war in the American press shows a new phase. Do you agree with that? That there's a new phase to this war, or are we just getting war exhaustion?
No, I think it is right. I mean, and it's a little different from, there have been several phases already, but those changed as a matter of choice on largely the side of the Russians. So, you've had the very first phase, which was the initial invasion. It was going to be very quick and light-footed and all that. That clearly didn't work. So then they started a new strategy. That didn't work. So then they pulled back from Kiev and they moved to focus on the Donbass region. But what we have now, those were all, what we have now is that you can still call it a new phase in the sense that it's pretty clear now that we're in for a war of attrition that's going to take a long time, months or years rather than weeks. So if that's the case, it changes all calculations for everybody. changes calculations about sanctions, about weapons provision, training, development of reserves, all that.
And also fiscal spending, Mark. And we are hearing about the potential alliance between a number of European allies to provide fiscal spending to Ukraine to rebuild, but also to spend on military, to spend on other initiatives. How much has this basically been an upending of the austerity of Europe and a move to greater fiscal spending that could come in the nearer term?
Yeah, I mean, we're talking about quite significant numbers. I mean, collectively, Europe obviously has deep pockets, but they are significant numbers. And I think the understanding now is, again, that, we're in for this for quite a long time. And that it's not only about the reconstruction of Ukraine when it's over. It's about how do you keep the country moving while the war continues, because it has to have a functioning economy. It has to have infrastructure that works, transport links that work. So all of that has to be done. So yes, it is quite significant.
There's a lot going on, obviously, Jack, and this war in Ukraine only exacerbates issues that people are worried about with inflation, which is really dominating the headlines here in the United States and, frankly, the political landscape. How much is this administration focused, and how much is it basically, choose your own adventure depending on the day and lacking a narrative that really can get it to the midterms?
Lacking a narrative, I think, is a fair critique, and responding to crises, just one crisis after another. Some of that, if you want to try to criticize the White House's messaging, fair enough. Some of it may just be very bad luck. But yeah, that's a significant issue. You see it with Democrats in Congress too. Mentioning the inflation concerns, sort of a very piecemeal approach to trying to show the American public they're taking action in any way they can. Some of it is a bit clumsy. There's some Democratic pushback even to the Democrats' bill on price gouging and the attempts to sort of shift people's focus toward price gouging or corporate greed, as some Democrats are putting it. But the struggles are real to try to sort of focus the attention where they want it to go, rather than playing whack-a-mole and just trying to respond to daily crises.
Jack, for our international audience, summarize the election of 2 days ago. How did the center of both parties do?
The center, as traditionally described for the Democrats, did not do well. John Fetterman in the Pennsylvania Senate primary was sort of seen as the progressives' pick, and won over Connor Lamb, the moderate House member who had impressively won a House seat a couple years ago and flipped it. Fetterman won by more than 30 percentage points. Big win for the progressives. On the Republican side, we're probably going to end up seeing a recount, but it's a very narrow lead for former President Trump's pick in Mehmet Oz of Dr. Oz fame. If he holds on to the narrow lead, I guess you could say he's essentially the establishment pick, if former President Trump is the establishment, but that's a very close one, so it's a little tough to say how that's going to pan out on the Republican side.
Hey, Jack, thank you. Jack Fitzpatrick there and Mark Champion on the latest worldwide in global politics. Futures right now off the lows, but still down about 1% on the Nasdaq and the S&P 500. One name to look at, Tesla. Dan Ives of Wedbush, big bull on this name, less bullish, says the following: the China headwinds are hard to ignore, still bullish, but lowers the price target from 1,400 to 1,000. Here's the quote, Tom. The success of the China story on both the supply and demand side are the linchpins to our long-term bull thesis in Tesla. That said, the reality is the current Shanghai lockdowns have been an epic disaster. The stock's down in the pre-market by 1.9%.
Yeah, John, bring up the board again. On radio, we're looking at 696.53 down 1.9%. John, I'm looking at like a 15-day chart of Musk. MUSK is a symbol, also known as Tesla. And I'm sorry, John, this guy's in some real trouble.
This stock's rolled over,
I don't know the details. I don't get it.
Tom, you've joined the dots between what's happening here and what isn't happening with Twitter, haven't you? That's your view.
I'm just talking about basic, like, margin call dynamics, stuff we know, and there's always stuff you don't know. I'm just looking at a stock from 1,100 down to 709 right now. That's when you're doing margin in debt, bad things happen when that occurs.
This is a big move from early April, Tom, down about, what are we, Lisa? Down about 37%. since the highs of early April.
And some people might say, well, this is partly just due to the shift in sentiment against some of the darlings of the pandemic era, which Tesla was one of them. Others would say maybe it's the flight of retail investors, although we haven't seen full capitulation, but more, you have a loose cannon in the C-suite. And frankly, he seems to be playing around with different areas and dealing with certain disruptions in China and beyond. And how do you do that without necessarily some sort of focus and predictability?
It's been a tough market from the 52-week high. Just looking at the Bloomberg chart, we're down more than 40% for that single name. They're not alone. There are so many other names that have experienced the same kind of brutal beatdown in this equity market. That 9/10 on the S&P 500 from New York City with Tom Keene, Lisa Abramowitz and Jonathan Ferro. For our audience worldwide, this is Bloomberg Surveillance.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City this morning. Good morning to you all on TV and radio. Here's your price action. Here's the good news. We're off session lows. Here's the bad news. Some negative follow-through from an ugly session yesterday. We're down 0.75% on the S&P. We're down 0.8% on the Nasdaq. And Binky Chatter over at Deutsche Bank does not think this is over yet. He points out that your average recessionary decline in the S&P 500 in the post-war period is 24%. With that in mind, he thinks the downside here is 3650 in the near term on the S&P, and then we recover. And Tom, we're hearing this a lot on Wall Street at the moment. A near-term price target, more downside. Longer term, a relief rally. The reason for that, if you look over at the work at Goldman, is this belief that any rally you get in the equity market might be perceived by this Federal Reserve as an unwarranted loosening of financial conditions and something they should push back against. Now, that is the complete opposite of the last 10 years, Tom. That's a real regime shift for this equity market.
John, we're rationalizing the moment, and we're comfortable, and it's used to doing that in equities. John, we need to rationalize the bond market as well, and I don't really see that going on.
The push-pull, let's talk about it, Tom. The relationship, the traditional one between stocks and bonds, is back, for now, at least. And we can talk about that right now, with equities lower and the bond market doing this. Yields lower too. So that inverse relationship between equities and bonds is decent at the moment. Equities are lower, bonds are up, Treasury yields are heading south, Tom, on a 10-year, 283. And remember 2 Mondays ago, 320.
Well, yeah, it's there, and if it breaks low, I mean, if you have a VIX to triangulate it to the VIX, John, a 31.91 right now, okay, that's stressful. I get it. What does yield do, John, if you pop a VIX to 38 or 40?
I would say this, Tom. What do yields do if equities start to rally again? What's driving what here? If equities start to rally again, do you get a move higher at the front end on a 2-year? Do you get a move higher in Treasury yields because people believe the Federal Reserve has to come in and do more, Tom, because equity markets are up and spreads are tighter
Now you've
again.
put the politics into it. How does the Fed blink against a slowing nominal GDP and a slowing real GDP?
That's what needs to break, Tom.
Yeah,
That's what needs to break.
Then that will be the relationship that will break all this mathiness we're talking about.
It isn't right now, and that's the problem you've got.
Yeah.
As an equity strategist, it's why we keep hearing the same thing. 3-month price target, 12-month price target. Near-term bearish, long-term relief rally, because everybody still thinks that this Federal Reserve will get to summer, reassess, that's the consensus view, and then start to take a step back.
Who's doing stocks? Do I have to participate?
Ramo's going to do that. You don't have to do that. Lisa's going to do some single names for you. Would you like to do that now?
Please,
we can do
Lisa.
that now. This is one of my favorite developments in this program. That I get to go cross-asset, and then Lisa gets to do some single names. Without a bearish tilt, obviously. Oh, look at that, Tom. Everything's negative. Everything's negative.
What else is going on? And honestly, and you know, if I'm too negative, we'll have Tom come up here and he'll do it as well, which will be fantastic. But John, you were talking about the broader picture. How much do these specific names really color what we're seeing? Target continuing the decline. The buy the dip, not so much in retail. Shares down 0.9% ahead of the open after yesterday's absolute carnage, down 25%. For the worst day for this stock going back to 1987. John, I know you've been picking up on this, the Dollar Tree stores and some of the other discounters that really cater to the lower income tiers. Also down 1.2%. But yesterday, John, it was incredible how much these were penalized. And I wonder if this is really going to be the epicenter right now of what we see going forward.
Lisa, things are super tough. The margin story for some of these names and the fact they can't find the right balance. What I've struggled with, Lisa, over the last couple of days in retail is trying to understand where the C-suite has just got wrong-footed by the change in the macro environment in the last 18 months, or whether there's something we should be really concerned about right now. Are the airlines telling you the same thing that, say, Target is telling you right now? I would say no. The airlines are telling you consumer demand is really decent. Everyone wants to travel. There's no pushback. Prices are up. Is this a change in the price mix, the product mix, or is this a change in the consumer? Is the consumer getting weaker?
Or is it a confluence of a lot of things that creates a rather toxic brew for CEOs? Kohl's is a very specific story. I know that Tom has gotten into that about the management. Shares down more than 5% after it really was another margin story. Revenues came in actually better than people had expected, but the profits not so much. And this has been a huge issue. Tom,
do you have a second screen?
Yeah.
Yeah, there's a second screen.
Oh, yes.
And I want to get to, hold on a second, and I'll whip through this really quickly so we can get our guest. But honestly, this is where the other toxic brew comes into play, the supply chain disruptions over in China. Cisco last night came out and basically said that any sales growth would be wiped out in the first quarter. Why? Not because of demand. Demand was just fine. It was because of what's going on with China and the lockdowns there. Cisco shares down nearly 12% ahead of the open after really reporting this. Again, this is not demand driven. This is a supply side constraint. Zoom, another one of those darlings from the system, the sort of tech issue, down also following yesterday's carnage in this shares, down 1.4% ahead of the open. And Amazon shares continuing their decline after a huge sell-off, down 0.8%. How do they right size, Tom, given the fact they are overstaffed for the moment that we're in?
You killed that. It was the pendulum of toxic brew that I heard that was just absolutely
Only
superb.
one Lisa Brammitz could come up with a pendulum of toxic brew.
Lisa, pro tip. Okay, this is really important.
Yes.
I first learned this on the Bear Stearns equity floor. Okay, it's a little more complicated than yield up, price down. Equities are a little more, remains delivered.
You're trying to say stocks are more complicated than bonds?
I think if you look at a 5-ratio DuPont series, there's some complexities there. It's just a different kind of mathematical dynamic than what you see in the fixed income.
Would you like to explain that to our next guest?
Hold on a second. John, is Tom trying to explain that things are complicated?
Let's go to Colin Martin right now before he hangs up. Colin Martin, of course, fixed income strategist at Schwab Center for Financial Research. Colin, you know what retail does is they look at their bond portfolio monthly. They're going to open the envelope, look at the computer screen, and go, what happened? How do they claw their way back with yield up, price down, big time?
Well, we do think it's going to be difficult for them to claw their way back, but you're right, Tom. That's the most common question we're getting, and it's not just the shock of seeing the price declines. It's what do we do now? And the unfortunate news we have to break to them is that we don't necessarily see a rebound in their bond mutual funds, because a lot of our clients are likely holding ETFs and mutual funds. And something that you all touched on before in terms of how much lower can yields go if we do get a risk-off environment, we just don't see that much room to go lower with inflation so high and the Fed likely to hike aggressively. So, unfortunately, we can't undo the past and the really poor performance we've seen this year. But the good news is that we do see a lot of opportunities out there, especially with higher quality investments. With yields up from treasuries and high quality corporates and munis, we're at yields that you haven't seen in years, highest levels of the post-financial crisis era. And of course, again, it doesn't undo what we've seen. It's not going to make the value of your bond funds suddenly get back up to the levels they were at the start of the year. But we do think it's an opportunity for investors who have been waiting for higher yields to put some of their funds to work.
All right, so where's the pain trade, Colin, especially as we look out in inflation that doesn't show signs of slowing, and we look at a Fed that is very concerned about this at a time when you have a complete reset of the globalization trends that really lowered inflation for so long. What is the pain trade for people who say bonds finally provide us income at a time when on a real level, they're still not?
Well, yeah, it is very difficult. I mean, when you talk about a real level, that's the question we get. I mean, if you're looking at it, a 10-year Treasury yield below 3% when inflation's at 8%, a real yield of a -5 isn't very attractive. We do think tips are one way to address the inflation situation, especially with real yields moving into positive territory. If you look at tips with maturities of 7 years and beyond, you can actually earn positive yields for the first time really since the pandemic began. What we're focusing on with our clients is not to take additional risks. So when you talk about the pain trade, where we see more pain ahead is likely in the junkiest parts of the market, like high yield. Lisa, you were showing those headlines before about single names, especially in the retail sector. Coming into this year, we were concerned about corporate profits. Now, we don't look at single names. We look at it from a high-level standpoint. And what I look at specifically for the corporate bond market is data from the BEA, because that aggregates all corporate bond info, large, medium-sized, small, public, private, you name it. And corporate profit growth was really, really slow in the fourth quarter of last year. And we were concerned about how the beginning of this year would look. And unfortunately, it's not looking too good. And we're seeing, even these big companies that should be able to manage a lot of these issues, especially supply chain issues, still kind of stumbling. And that poses a risk for the junkiest parts of the market. If you're a triple C rated issuer, a single B rated issuer, you have those ratings for a reason. And you might not be able to handle any disruption to your operations, supply chain issues, volatile cash flows, things like that. So we think there can be more pain with junk bonds.
Colin, just quickly, just one point, and it's a question really for the equity guys. There's a lot of people coming on the program right now. I see it a lot in the research on the equity side, that you get to the end of the summer after a 3-month call, and then you get a relief rally because the Fed backs away. What do you think needs to happen for the Fed to back away from what it's determined to do at the moment?
I'll steal Powell's line and say that we need clear and convincing evidence that inflation is retreating. And we don't have that just yet. If you look at the CPI report for April, it did come down. It decelerated from the previous month, but still at very, very high levels. And there are a lot of things under the surface that indicate that inflation can still remain high. I mean, we're still seeing wages grow, and we're seeing a lot of prices paid indices from the various Fed indexes, from the ISM indices, both manufacturing and services, that prices are still high. So if we get to the summer and inflation has only showed a modest retreat from the highs, that might not be enough for the Fed to slow down. And even when we talk about a slowdown, the Fed's not going to stop hiking rates. They might just revert to 25 basis points as opposed to 50. And if you look at what the Fed funds futures market is pricing in, despite all this volatility over the past 5 or 6 weeks, markets are still pricing in 2.7, 2.8 for Fed funds rate at the end of this year, despite all that.
And I know people who think it's going to go higher than that, Colin, as well. Colin, awesome. As always, buddy. Colin Martin of the Schwab Center for Financial Research. Thank you to everyone writing in. This from a Bloomberg subscriber. Take this man's tang away and put him in timeout. Stocks are not more complicated than bonds. You've upset some people this morning, TK. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden meets today with the leaders of Finland and Sweden to discuss their bids to join NATO. Turkey's President Recep Tayyip Erdogan is opposed to the move because of the two countries' stance on Kurdish militants that he considers terrorists. Turkey called on NATO members to do more to address its security concerns. In London, police have wrapped up their high-profile Partygate investigation that already caught Prime Minister Boris Johnson. More than 126 fines have been issued over COVID rule-breaking parties held at Downing Street during lockdown. None of those fines were identified, but a spokesman says Johnson will not be fined a second time. Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it wouldn't be able to make payments within the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and a political crisis. Authorities warn that inflation may hit 40%. Another U.S. retailer cutting its profit forecast. Kohl's has reduced its outlook for the full year. First quarter sales and profit missed estimates. Kohl's says it's reviewing strategic alternatives and continues to engage with what it calls multiple interested parties. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Stocks don't go up when inflation's running north of 4%. And just, so historically that's the case. So yeah, I think it's a tough, situation. And I don't think the market this year is going to put in a great year.
That was Andrew Sliman, the Senior Portfolio Manager of Morgan Stanley Investment Management. Your equity market looks like this. We're negative by 0.9% on the S&P. On the Nasdaq 100, down by about 1%. Euro dollar, just about positive 105.23, up 0.6%. This will excite you. The ECB accounts out in the last 10 minutes.
Oh,
some
Lisa,
officials,
please weigh in here, Lisa.
Some officials, she loves this. Some officials wanted to act without undue delay. I don't know why they like to call them the accounts, but they do.
Right,
There's less detail, perhaps. I don't know. The outlook for the third quarter growth is still, quote, relatively positive. Do with that what you will. I don't know. Their account of the policy meeting reads as follows as well. One more headline, Lisa. Officials saw the war slowing, not derailing the recovery.
That's what I picked up on as well, at a time when more people are talking about recession in Europe and people use that as their base case. I mean, we talk about that in the U.S. So how much is this basically an ECB setting up for rate hikes and possibly getting to zero non-negative deposit rate by the end of the year? And that, I think, is what basically they're trying to confirm.
John, can Leicester City beat Chelsea today?
Is that your focus?
Yeah, that's my focus.
You're more excited about that than June 9th.
Can Leicester beat Chelsea today? What do you think?
They have a chance. Chelsea's not exactly playing well.
Okay, fine. Thank you.
That's your review.
Kriti Gupta's going, let's go. She's got a chart. Kriti, what do you have this morning to save us?
Well, if I can harp on what Lisa was just talking about, the recession odds in Europe, that seems to be the base case. Well, that's feeding into a lot of flows for the dollar. Of course, today you do see the dollar weaker, but I want to tie the dollar story to the stock story, which brings me to my chart of the day. The 40-day day inverse correlation between the stock market and the dollar. Essentially, for our radio audience, what you're seeing is a sea of red. What it shows you is that during the pandemic, there's been this dynamic. A weaker dollar equals higher stocks and vice versa. And now, right now, of course, you have that correlation sitting at about a 0.4. Statistics nerds will say that is not significant, but if you look very closely, it tends to bounce back to a 0.7, which tells you that that is a very serious relationship, especially when it comes to capital flows. Do foreign investors, in the face of COVID lockdowns, in the face of those European recession odds, flock to the dollar and therefore flock to U.S. stocks? So keep an eye on this relationship.
Kriti, thank you. Greatly appreciate that this morning. This is a timely conversation with somebody that's covered all of American politics from his New Hampshire back decade and decade in this topsy-turvy world. Greg Valliere, AGF Investments, with us this morning. Greg, I want to go bigger, broader here. 3, 4, 5 years ago, if you and I were having a beverage of our choice about Ronald Klain, we would talk about a hugely respected, bright attorney, respected by Republicans and Democrats. He's driving the ship at the White House. What is Ron Klain and the Biden staff doing to provide a cohesive message for a president struggling?
Not a lot, Tom. Good to see you this morning. I think that there's a perception, fair or not, of the White House being in disarray. I think with a debacle shaping up in the November election, Biden has to do something. And he's not going to get much legislation out of Joe Manchin. So I think what Biden has to think of, it sounds harsh, but he has to think of a staff shakeup. And if there's a staff shakeup, Ron Klain would have a target.
I mean, Ron Klain would be a target, but if we say he's Panetta-like, all of us internationally, domestically, forgetting about the previous administration, whatever you think, are baffled by this White House. Help us with the next round of shakeup, if you will.
Well, I think they have to focus on not just personnel, they have to focus on policy. Will there be a decision finally on student loan relief? Will there be a last-ditch attempt to work with Manchin on some social programs? They need to show the public they can get something done. And with the exception of a pretty good unity within NATO, there's not much they can show.
So there's a lot of controversy over the spending that was done during the pandemic, particularly the stimulus checks that a lot of people look to as part of the driver of inflation right now. But other people are saying, especially heading into what could be a downturn, spending will be important, especially on some specific areas of infrastructure and defense. What are you seeing in terms of any consensus in D.C., given the disruption, the turmoil that you talk about, to get some of that done into the midterms, but really beyond?
Isn't it ironic, Lisa, that just when the economy starts to look like it's failing, just when you could use some fiscal stimulus or monetary stimulus, you get neither. And I think both fiscal and monetary policy will be contractionary. Frankly, I only see one area on fiscal policy where spending could go up by a lot, and that's defense. I think there's a consensus in Washington that we've got to do more on shipbuilding, on purchasing new jets, and maybe coming out of this weekend's meetings between Biden and Asian leaders, we get a commitment for even more on defense.
Yeah, how much is the focus completely going to be on Taiwan at these meetings?
A lot. I mean, there's 2 or 3 quickly things that they're going to focus on. Can we have South Korea get along more with Japan, new government in South Korea? Could we bring India on board? Washington's been disappointed by India. I think they'll try on that. But the main message is to send a signal to China. I don't think Xi is ready to go after Taiwan now. After what happened in Ukraine, with all the sanctions, I think we'll see a stalemate there. But you'll see a strong signal from Biden, largely because of anxiety over North Korea.
Greg, words or policy?
I'm sorry, John?
Are they going to use words or policy? What are they going to do?
More words, yeah, more words than anything else. I think they want to show the flag. They want to let our allies in that part of the world know that we'll never do an Afghanistan again, that we are rock solid in our support. And I give Biden credit on what's happened in Ukraine, but he needs to send a signal because North Korea is very close to testing more missiles.
Well, Greg, they've sent a signal, haven't they? Look at what's happened with Ukraine. Won't the Chinese just look at what's happened with Ukraine and say, okay, we heard you, thanks, we're going to do what we want anyway?
Well, I do think that China has to worry. If they tried to pull what Russia did, they would face enormous world sanctions. They would not succeed militarily. So I think that would be a signal that has already been well received by Beijing.
Greg, important thoughts, as always, sir. Greg Valliere of AGF Investments. TK, you said it, and I don't know why we just can't say things out loud anymore. Because everyone's too scared
because
of being
this show is a toxic brew.
Tom, you can say things out loud if they are true. The previous administration, it was chaotic. It was messy. You can say it. Yes, someone might accuse you of being a Democrat. They might accuse you of being a Republican. But if it's true, you can say it. It is objectively a fact. You can also say this, that if the previous administration was not there, you would say that this administration was the messiest administration, Tom, you had seen in a long, long time.
I will let the full Brit make that opinion and not me, because I'll get in the timeout chair. John, true story. And folks, we have this acclaimed Bloomberg information system called the message system, which basically is one part Twitter, one part email. John, I had one message come in from a wonderful fan once and said, you're to the left of Putin, to the right, the left of whatever, and the exact next message said I was to the right of Attila the Hun.
Tom, how many guests have you heard in the last 12 months say Ron Klain's got a target on him? Yeah. Ron Klain's still there.
True.
How many times have we heard that? I've heard that so many times in the last year. Futures down 8 cents on the S&P, on the Nasdaq 100, down 0.8% also. From New York City, this is Bloomberg.
Nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It could be a situation where the consumer is saying, no more inflation, I'm not going to pay the higher prices.
Their ability to spend on things besides those true staples has been diminished.
We are looking for peak, at least in headline inflation.
It's going to be harder to get that soft-ish landing.
I would say recessions are pretty likely in 2023 in lots of places. I think it's just plain blind luck if we can avoid them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, I think, everybody. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a toxic brew out there with a market in modest recovery from where we were 2 hours ago. John, everyone recalibrating.
That's the good news, Tom, that we're off the lows. The bad news, we're down 0.75% after the biggest daily drop going all the way back to summer 2020. They weren't good times. TK, everybody is reassessing, but they're reassessing in a very, very peculiar way. They're reassessing in the short term, but not in the long term. And I keep seeing that on the south side, Tom, in the equity market. In the short term, very cautious, high cash, looking for more downside. In the long term, looking for a relief rally. Why? Because you've said it a million times this morning. There is a belief out there that if things get tough, things get bad in this market, that this Fed will step back.
Well, that's a bet right now. We have a really confirmed bull coming up, folks. This is must watch, must listen. Bloomberg Radio TV. John Stolfus with us in a moment. John, I want to go to something we haven't talked about in the last 2 hours because I know people are glued to this, and that is the real yield coming back within the vicinity of zero. What a shock if we return to a negative real 10-year yield.
Yeah, and that's been a change as well, Tom. We were looking at a one-way road towards higher real yields,
well said.
And then we've backed off because largely, Tom, the shock has changed. If you think about it in a three-step routine here, we've gone from an inflation shock to a Fed shock, a big pivot, a rate shock, and now we're talking about a growth scare. That third piece, Tom, is what we've started to price a whole lot more recently.
John, is it the same in London, in the city?
In terms of what, Tom? The cautiousness?
The cautiousness.
Without a doubt.
The
Even
sweat.
more so, I would say.
Why?
Because they're conditioned by what is happening in the UK right now. You're always conditioned by your surroundings. In the UK, high inflation, upside risk to inflation, downside risk to growth. You look across the border, across the channel to Europe, they're facing recession. That's the early part of the story. And I'll say this as well for the UK and Europe, Tom. The difference between the UK and Europe right now is that in the US, people believe that peak inflation is in our past. In the UK and Europe, they think that number is still in their future.
Road trip, Lisa. We got to go to the Toxic Brew Company, Dayton, Ohio, 45402. Lisa, you said it. It's a toxic brew that captures perfectly the emotion that's out there. What are you focused on?
Right now, this idea of the market basically looking at stagflation, right? They're basically talking about inflation that's going to be persistently high and growth that's coming down. And they think that the Fed is going to start backing away. That seems to be the consensus baked into the idea that two-year yields are coming in. They're actually coming down even after Fed Chair Jay Powell said we will do what it takes to bring down inflation. So how does this translate over the longer term? Is this basically people expecting that inflation will roll over sooner as a result of demand drop-off, Tom? And if that's the case, what else do we have to price in terms of some sort of downturn?
Let's go to Brahma 101 right now. What do you see in credit spreads? I mean, I get the tension there. I get the reason the pros are watching. The difference in whatever the yields are in the discussion, Lisa, why does it matter
Carnival,
right now?
Tom.
Yeah.
Carnival. It's all Lisa wants to talk about.
Let's talk about Carnival. So basically, the cruise line operator yesterday sold debt at 10.5% yields. This is big. They sold debt 7 months ago at 6% coupons. This is 8-year debt. And this morning, it's selling down, right, in the trades, early trades. Basically, people are now demanding even more yield. Why would a company come to market to actually raise debt, number one? But number two, what does this say about when companies actually have to raise money of how much higher those financing costs are going to be?
We got to stop the show. Should we do a cruise? Can you see the three of us?
I don't think we should do a cruise.
February?
I do think we should pick up on two really important points that Lisa just made, Tom.
Good segue.
No, out of Jacksonville, John, we can do a cruise and give lectures.
Evidently
you can
not
wear
so much.
Speedo. I'll wear,
John,
something appropriate.
I'll interview you, Lisa.
We can do a cruise to the Caribbean.
You've made 2 points here. Is there a problem with the company? One. And two, is there a problem in broader markets right now? I think there's always a difference between the price adjustment in credit and then you start to worry about whether a company can actually come to market or not and raise capital. They came to market, they had to offer up a whole lot more yield, and then you're saying the performance in the secondary market, the new issues, is poor. It's weak this morning. So let's make 2 points here. First, tell me about what you think this means for the company, the fact that it came to the market in conditions like this. And two, tell me what your response is to how we're performing in this new issue market off the back of what got issued yesterday.
Well, we can string it throughout the entire show, but basically, it seems like there are a lot of mysteries to be unpacked, but this new issue market is not friendly right now to companies that need to borrow.
Everybody's making it up as I go, is my subtle analysis. John, I'm looking one number on the screen, safe haven switch. As of yesterday, we saw strong Swiss franc. Not a big deal, but it's a little tea leaf of the sweat that's out there.
Yields in a bit as well. We're down 4 basis points on a 10-year to 2.84 right now on a 10-year yield. And just to wrap things up, futures down 9 cents, Tom, on the S&P.
Our conversation of the day, as we talked to Patrick Pelfrey of Credit Suisse earlier, John Stolfus joins us with Oppenheimer & Company, their asset management chief investment strategist. John, thrilled and honored to have you on today. You will rationalize this to retail and institutional. How do you have courage to own equities this morning?
Well, Tom, thanks for having me on the show. Got to say where we are right now is the market's all kinds of in a tither because what's happening really is we're moving from free money to money that is less free. Is essentially perhaps easy money, a long way from what a lot of people are thinking here. And I think that the danger is negative projection, taking anything that's crossing the tape here that's worrisome and projecting that that will stick. The big call here is just wait until, regrettably, we have to wait a little bit to see if what the Fed is doing is the right thing. And if that shows that inflation goes into check, things will get a lot better, we would expect.
John, the fabric of OPCO, and this is the legendary Myron Picot insurance securities analysis, is details. What is your experience of how corporations will adapt and adjust to this new 2022?
Well, I can't help but think of that cruise line that we just heard of.
You want to go on the cruise too?
Well, no, I don't know if I want to go on the cruise, but I can tell you this: I'd love to see the features on the covenant of that bond. You can just imagine when it's callable. It's probably very flexible. They're paying a ton of money right now in terms of the coupon, but I'm willing to bet you that if things get better, that bond will get called pretty quick. That's not with seeing. I have no idea what the covenant looks like, but you just got to figure they're going to protect themselves, and their bankers got to protect them, and with reason. The only difference, I think, where we're going is bond issuers are going to begin paying for the privilege of borrowing money, and lenders are going to, or bond buyers are going to get paid commensurate to some extent anyway, at least to the risk that they take on just normally when they buy a bond. And that's a healthier environment than free money, which we've been living in since the pandemic in April 2020.
John, you said a couple of things that are concerning, a ton of ifs, and then you said their banker will protect them. I'm not sure that brings a lot of comfort to many people this morning, John, because I've heard a lot of people saying this year to stay long equities, and we're down hard, really aggressively so. And now, John, the new line on Wall Street that I'm hearing is that in the next 3 months, things improve after that period because this Fed has to back away. John, the end of the summer feels like a lifetime away for people who have lost about 30% this year, and maybe even more so in single names and crypto. What are they meant to do in the next 3 months?
Well, John, you're pointing out the most aggressive stances. I mean, likely traders who are, it's greed and fear and a lot of leverage. for intermediate to longer term investors, you know, when they look out, this is likely, in hindsight, to become a bump in the road. Usually when the Fed is in the process of either taking away liquidity or adding liquidity, right away, the smartest guys in the room always say the Fed is going to fail, Fed is pushing on a string, and then the Fed does its thing. Sometimes it makes mistakes on the way, but generally it has pivoted successfully to either bring the economy back in line with much more reasonable rates in terms of coupons, or it becomes more accommodative. It all depends. And, you know, I've been doing this for 39 years, and my gut is telling me right now, this looks a lot like 09, early 09, before things straightened out. It looks like 1994. It looks like the fourth quarter of 2018. And these things, if you projected negatively on that point, you missed the rally that followed thereafter, things were basically right-sized.
I hear you, John. I hear you. John Stelfus there on the latest. And just to point something out, it's not the most extreme view. This is the consensus view on the street right now.
Yes.
Not my view. Here's the data. The median forecast on the S&P 500 year-end is 4,800. It's 4,800. Tom, just look at the market where we are. This street is still very bullish going into year-end. The only thing that's changed is that near-term, on a 3-month basis, they believe there's more downside risk. On a median basis, base case consensus view, the Wall Street is still very bullish.
They will recalibrate here, particularly with the calendar of into May, into June, and I would suggest 4,800 will come in. I would look far more, John, at expense, mergers, transactions, combinations. What are corporations going to do to move forward? For them, these are huge adjustments.
And Lisa, I'm not here to say that that median view is going to be wrong. I'm just here to point out that it is very, very detached from what's happening now and over the last 5 months.
And how much of it is completely dependent on the Fed blinking, on the Fed coming in and saying, actually, we're not going to go quite as far. We're not going to have to do as much because inflation is starting to ease. How much is that baked into a lot of the valuations and assumptions in those bullish views?
Futures down 9/10 on the S&P. On the NASDAQ, we're down about 1 full percentage point from New York City on radio and TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China's top diplomat has again warned the U.S. about its increased support for Taiwan. In a phone call with National Security Advisor Jake Sullivan, Yang Jiechi said the U.S. is going down the wrong road and that could lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. There is a sign that Beijing is strengthening its energy ties with Moscow just as Europe turned towards banning imports. Bloomberg has learned that China wants to replenish its strategic oil stockpiles with cheap crude from Russia. The strategic reserves are tapped during times of emergencies or sudden disruptions. And President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. Another U.S. retailer cutting its profit forecast. Kohl's has reduced its outlook for the full year. First quarter sales and profit missed estimates. Kohl's says it's reviewing strategic alternatives and continues to engage with what it calls multiple interested parties. Spirit Airline has rejected JetBlue's latest $3.3 billion takeover offer. That sets the stage for possibly contentious vote by shareholders. Their choices, either to back JetBlue or stand by a pending combination with rival deep discounter Frontier Airlines. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
I would say recessions are pretty likely in 2023 in lots of places. I think it's just plain blind luck if we can avoid them with the number of pressures coming to the system. But Europe is right in the firing line.
I don't think strategists should be able to come on and make a call the day after their team lost. That was Kit Jukes of SocGen the day after Arsenal lost, and he was so gloomy and bearish, Tom.
He was.
Do you think there should be a regulation against that? If your team lost the day before, you just don't get to come on.
Yeah, I think there should be a surveillance rule on that. I agree. You know,
you have to let him respond to that. Come on.
Futures down about 1% on the S&P. On the Nasdaq, we're down about 1 percentage point. Just bear in mind that AC Milan has a title-winning game this Sunday, and I'm not at work Monday. Okay, just remember that.
Very good.
So,
very
I'm
good.
just abiding by my own rules.
Well, that's very good.
Okay.
You know, Milan can be good. I like some of the food at the train station there.
Thank you, Tom.
It's very good.
Thank you for weighing in.
Let's move on right now, and we are guilty of this, and I am incredibly guilty of this. We look at, well, the joke of me going below 59th Street, or the idea that most of our audience is in 3 zip codes and a couple in London as well. And we forget about the open plains. Mike Rounds knows where the Missouri River is. He knows that getting from Pierre, not Pierre, but Pierre, South Dakota, over to the Target store up I-29 north of Sioux Falls is actually something difficult to do. Ever more so at $5 a gallon gasoline. The senator from South Dakota, their former governor, joins us this morning. I want you to give me a visceral picture, real estate guy, of the emotion in Pierre and the emotion at that Target store north of Sioux Falls. What's going on out there away from the fancy people like Global Wall Street?
I know you like dollars and cents. The average South Dakota family right now is paying over $604 more per month in living expenses than what they were in January of 2021. That's $7,000 plus per year more, and wages aren't going up that fast. When you start talking about that in places like South Dakota, the pain is real, and it's the same thing across the entire country. And the worst part about this whole thing is this is policy induced. When you start driving up the price of fuels, diesel, natural gas, and so forth, by policy determination, and you start limiting the amounts of supplies that are being produced, and you recognize that you're doing it, and you do it anyway, then it's a policy-induced movement. We can do a lot to change that right now in the United States, and it's got to come back down to an administration recognizing that, look, I know they're fighting climate change, but the bottom line is you've got to have a strong economy to do a good job on that. And they are hurting this economy with their policies. And people in South Dakota feel that, and they're not happy about it.
Senator Rounds, Gerald Ford of the Republican Grand Rapids, Michigan persuasion years ago said he was going to whip inflation now. What is the Republican prescription day one to stop this inflation?
There are three parts to the policy. One is demand. You can do that through action of the Federal Reserve, but it's because we put a huge amount of cash into the economy earlier. And that was a Biden decision, and he did it without the assistance of Republicans in January of last year. Number two, you have to reduce the cost of energy, and that means you produce more energy, all of the above. Whether it be nuclear, whether it be more pumping, it means more leases being released, and then allowing them to get that crude oil out of the ground with additional licenses, and then allow them to be able to actually move that to the marketplace with pipelines. That would be an immediate thing. And finally, you have to address the workforce issues. Right now, and I know that this isn't a popular thing to talk about, but we have to have legal immigration reform. We need visas, we need H-2B visas, we need H-2A visas right now. And we've got legislation in place right now that we're recommending that would do that. All of those would help to reduce inflation in this country, and the effects would be immediate.
Well, Senator, just to push back a little bit, you're talking about the issues with certain policy prescriptions that led to the inflation, but a lot of economists say is driven by some of the supply disruptions, whether it's in China or particularly the war in Ukraine. How much do you see as inflation staying high as a result of certain national security decisions being made that you've supported?
Yeah, first of all, I think the actual inflationary trends with regard to the supply chains and so forth, a lot of that has to do with the cost of transportation of those items. Now, can you have supply disruptions? We had it during the previous administration, but you did not see that driving up inflation. You saw inflation begin almost immediately upon the recognition that we were going to have increases in the cost of energy within this country, and they were going to be increased by policy determination. Once again, if you take back and you look at the actual costs of energy and the impact of that has on all types of pricing for services and for products, it's a no-brainer that you can begin to reduce inflation if you address the cost of energy. It's in all of those products.
Aside from just the energy issue, though, I'm wondering, Senator, would you agree with potentially relaxing certain tariffs on China, or perhaps changing certain stances in order to reduce inflation domestically, even if on a national security level it was viewed to be prudent to keep certain things in place?
I think that there is always the possibility of looking at modifying policy with regard to needed items. But remember, there's a reason why we put those in place in the first place, and that was to try to develop domestic production. But if you can't do it domestically and you've tried it, then to look at other alternatives with other countries. It's not that we want to produce everything in the United States. We'd love to have good trading partners. But we also have to recognize that simply going back to China does not fit into the long-term scheme. And as long as they're going to try to continue to steal the IP in this country, we've got to continue to recognize the need for enforcement of trade deals and the limitation of trade with China whenever possible, until they come around and recognize that they can't be stealing the IP, the copyrights and so forth. So, yeah, look, I'd be very stingy about going back on what we've already done with China. I try to develop some of those product lines with our other allies and other people that literally want to do business with us under the rule of law.
Senator, thanks for your time today. We appreciate it. Senator Mike Rounds there on the story at D.C. and worldwide. And Tom, there are only a couple of things that I think you can find that Democrats and Republicans agree on at the moment. One of them is China, and has been now for a number of years.
And on this Indo-Pacific trip, that trip for the president, that is absolutely the immovable force. And quite frankly, whatever happens 2 years from now, John, why is that going to change? I don't I don't suggest it would change.
A difficulty for this administration and the previous one for that matter too, Lisa, is how do you reconcile your domestic economic problems, your goals here, with your foreign policy objectives as well? China front and center. Russia too, for that matter as well.
And Europe has that problem much more, frankly, than the U.S. right now because of trying to wean themselves from their dependence on Russia for gas and oil. But in the U.S., how much is it going to increasingly be a calculation? How much do you keep a firm line when it is causing prices to go up? And frankly, you're on a 4-year election cycle. Honestly, John, this has been one big issue.
It continues to be a monster issue. Futures are down about 1% on the S&P, on the NASDAQ 100 down by 1.14%. Yields are a little bit lower. We're down 6 or 7 basis points to 281.90, and crude is down a little more than 2% at $107 a barrel on WTI. From New York City, for our audience worldwide, this is Bloomberg Surveillance.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Some economic Economic data in America just moments away. Futures are negative by about 1% on the S&P. On the Nasdaq 100, down by a little bit more so. Yields are lower by 6 or 7 basis points on a 10-year to 281.90. Waiting for some jobless claims in America as we wait for that data to drop. Here's Mike McKee. Morning, Mike.
Good morning, John. 218,000, so a slight rise in the number of people filing for first-time unemployment claims. 203,000 was the unrevised number last week, waiting for that revised number to come in. The other number that we want to keep an eye on here is the Philadelphia Fed, because remember the Empire Index collapsed last week, or earlier this week, I guess it was. The Philly Fed Manufacturing Index comes in at 2.6, it looks like, which is significantly lower than 17.6. So, which was the April number. So it looks like a slowdown there. New orders, though, rise in the Philly index. The other one that we want to see is prices paid fall, 78.9 versus 84.6. So mixed numbers out of the Philadelphia manufacturing. Not sure what that tells us about the progress of the economy, but jobless claims tick up just a little bit. They're still within a range. Doesn't suggest that the labor market's falling apart, but maybe we're starting to see people hire a little bit more slowly.
Just a really small shift in the market, Mike, and thanks for that. Equities are lower by 1.15% on the S&P, basically the same on the Nasdaq 100 too. See a little bit of a shift. I put the emphasis on a little bit. In the bond market, yields come in an extra basis point on a 10-year to about 281. A 30-year, a break of 3% TK. We're down about 7 basis points on the day.
Yeah, it's important. 30-year bond under 3%. Now we'll have to watch that carefully, see how it plays off of this data. Mike McKee, I've got to ask you about the gentleman from Carnegie Mellon. What was the major distinction yesterday with Charles Evans? What did he say that got your attention?
Well, I think he has gone from we don't need as much at the beginning of April to now we may need to go above neutral to slow down the economy. That's probably the takeaway from him at this point as far as the markets are concerned. But you know that something very interesting has happened. The markets have moved the yield curve above what the Fed officials are saying is the neutral rate. So forward guidance is making a big difference in the economy right now compared to interest rates. We're already priced for neutral or above. So maybe we see the economy slow a little bit more quickly than people on Wall Street are fearing. And that raises the question, does the Fed go too far, too fast? But it could also mean maybe they have to do less in the long run.
Mike McKee, thank you. Tom, I think that raises the big question right now. It is so difficult to strike the right balance in this economy, whether you're in the C-suite or in the central bank.
We're all making it up as we go. There's just no other way to put it. Down negative 363, SPX negative 46. The VIX was a 33. I'm going to call it fractionally improved in the tumult, 32.15. Well-timed, Stephen Stanley, Amherst Pierpont, who is brilliant at forecasting. Steve, I got to go to your wheelhouse. Have you changed your forecasts in the last 48 hours?
Well, I guess the one thing that has changed a little bit this week is the retail sales numbers for April were quite a bit stronger than expected. So it does look like the consumer retains a lot of momentum. And obviously, as long as that's the case, the economy should be in good shape, at least in the near term.
When you look at Fed policy and the idea of the Bloomberg Financial Conditions Index tightening, what Michael McKee just said about terminal value dynamics, is this a Fed that will change its tune before the June meeting?
No, I think they are very much focused on inflation until they see convincing evidence that inflation is coming down towards something that they can find acceptable. They're gonna plow ahead. And I think Chairman Powell wanted to take away a lot of the near-term volatility. Chairman Powell and the whole FOMC, it seems like, by announcing that they're likely to go 50 in June and July. I think that's pretty much baked in the cake, and then we'll see what happens once we get into toward the end of the summer and into the fall.
This is exactly why I find it fascinating that some of the turmoil that we're seeing in equities and other risk assets are really translating into a bid for bonds, even on the short end, even on the 2-year yield. Do you think that this is misplaced in terms of what people's confidence is that the Fed will actually step back a little bit from an aggressive plan in the face of stagflation?
Well, I think financial markets have a really tough time discounting things that are likely to happen or may happen in the distant future. So we have this tug of war right now between a strong economy and very firm inflation in the short term versus the possibility that the Fed's going to end up tightening so much that we get a recession somewhere down the road. And the debate really is about the time frame of that and the likelihood of that. And I think the markets are just having a hard time with that. The markets want to look forward, and they want to, if something's going to happen 2 years from now, they want to price it in today, and it makes it very tough. I think personally, I think the fears about recession are a little bit overblown, not in the sense that we're certainly not going to get a recession. I think that a recession is at least a 50-50 bet, given how far the Fed's likely to go. It's just that the timing is pretty far down the road. I think we're talking about 2024, maybe later. And again, I think the markets just have a really tough time trying to properly discount something like that that's so far down the road.
And you say something, how far the Fed is going to go, how far they are willing to go. And right now it seems like people are bringing that back. Actually, even as Fed Chair Jay Powell says we may have to move to a restrictive stance, and other Fed members say the same thing, the market is saying, nah, not really. You'll get to neutral and then you'll reassess. Do you think that this is also wrong, that perhaps the terminal rate is closer to 3.5% for the Fed funds rate rather than 2.5 or 3?
Yeah, I do. I think the Fed's going to have to work pretty hard to get inflation down. I think we've had high inflation long enough that people are starting to get used to it, which means it's going to be harder to snuff out. And this has been a big focus of mine for a long time. I think the markets are not pricing in a high enough terminal rate. I think we're likely to see something closer to 4 than to 3 at the peak of the cycle. And that's why I think that there's a really good chance that the economy is going to slow down 18 months, 24 months from now. But in the meantime, I think there's a lot of momentum, and I do think that inflation is going to continue to be a problem for certainly for the near term.
What does nominal GDP do, Steve Stanley?
Well, in the near term, it's going to be high. I think real growth this year is going to be in the neighborhood of 3%, and prices obviously are rising very fast, so nominal GDP is going to be in the high single digits this year, and probably still in the mid to high single digits next year, so well above what is sustainable in the long term. And again, that's why the Fed is having to do what it's in the process of doing.
Stephen, we are looking at a market that is searching for a narrative and struggling to coalesce around one. Right now, the dominant narrative is that you are seeing a deceleration in spending, you're seeing consumer pull back, and you're seeing companies with margin squeezes that we've been waiting for and are finally starting to read in the data. How much, the data, I should say, how much are you looking forward and seeing this as the predominant narrative in the months ahead?
Well, I think the consumer still has a lot of momentum. You look at the numbers on the household balance sheet, and households are sitting on trillions of dollars of extra savings that they accumulated during the pandemic. And now that the economy should be pretty much fully reopened, I think we're going to see a bit of a feeding frenzy in the late spring and into the summer in terms of travel and going out, whether it be to restaurants or to ball games or to shows or whatever the case may be. I think we're going to get really strong consumer spending over the next, call it 3 to 6 months. Beyond that, we'll have to see. But I do think that the economy retains considerable momentum in the short term. And I would just, one comment I would make, I thought it was interesting that the takeaway I had as an economist from the Walmart and Target results, which, it seemed like the predominant narrative around that was that the consumer is slowing. But basically, what I heard is demand is still strong, but profit margins shrunk because they underestimated how much their costs had gone up. And unfortunately, that means that going forward, the next step should probably be more price hikes to recover those lost profit margins. So we'll see. At some point, there's a tension between that and consumers' willingness to pay, and maybe we're getting to the edge of that for certain products. Certainly housing, it seems like people are starting to balk at high home prices, and we'll see that, I think, more broadly across the board at some point, hopefully. But there's a big tension there in the short term, and I think it'll be an interesting dynamic over the next several quarters.
Stephen, great to get your views as always. Stephen Stanley of Amherst Pierpont. Lisa, just on that final point there, does it resolve itself in a favourable way for this economy, for this market? And for a lot of people, the bias is so obvious, it's kind of lose-lose at the moment, because if they can pass it on to this consumer, that means prices are up and the Fed does more. And if they can't, people will be worried about a downturn.
I completely agree. So it is lose-lose, but the nature of the loss in markets is going to be different, right? And this is where, again, the bond market reaction is fascinating because it's taking the negative side of that, basically saying this means they cannot pass along the prices to consumers, to Stephen's point. What if it's the other way around? What if this is just a precursor to more price hikes? And if that gets passed along just fine, because frankly, the appetite to spend is there.
That's the bearish bias at the moment. Do you remember retail sales? It was only 2 days ago. Tom, no one talks about the retail sales data point at all. It was only 2 days ago.
Stephen Stanley started with that. And, you know, again, this is a central bank that is data dependent. I would suggest the market is doing a lot of the heavy lifting for Jerome Powell.
Isn't that your drinking game? Data dependent?
Yeah, it is a data. Yeah, it is. You know, well, the Tang is here, and
any excuse, right?
It's Polish now. Okay, good.
Sure, good. Enjoy.
John, we've had a huge response to the thinking of a cruise, and I need your advice, John. Do we do like a Miami to Barbados thing, sort of easy for people to get to, or do we really go large and do more out of Athens?
I mean,
where you go circular
you're going to have
back
to confirm
Mykonos?
how much you're going to pay me to get on this ship, because I'm never going on a
John,
cruise.
the speaking fees are stunning.
Can I just tell you, so this is the way the conversation goes. Tom's saying, we're going on a cruise. John says, no, we're not. I'm never going to go on that. And Tom says, where are we going to go? Let's discuss. And John says, no, not going to do this.
No.
This is the morning. This is
I've been
Bloomberg
going
Surveillance.
back and forth with Cruise Critic. They're really, really wonderful.
Just cruise.
February 2023. I mean, John, it's doable. Miami to Barbados.
The reason I do this, Tom, is because in about 2 minutes I get to walk away. The idea of being stuck on a ship with you.
Oh, no. We have
All
our
right, now we're getting to
separate
Dr. Phil.
houses.
That's tough. Future's down 1.2 on the S&P.
I have floaties, so I can swim.
And you told us about your choice Speedos too.
Yeah, I got that right.
Hard pass on that from New York. This is Bloomberg.
No pun intended.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden meets today with the leaders of Finland and Sweden to discuss their bids to join NATO. Turkey's President Recep Tayyip Erdogan is opposed to the move because of the two countries' stance on Kurdish militants he considers terrorists. Turkey called on NATO members to do more to address its security concerns. In London, police have wrapped up their high-profile Partygate investigation that already caught Prime Minister Boris Johnson. More than 126 fines have been issued over COVID rule-breaking parties held at Downing Street during lockdown. None of those fined were identified. A spokesman says Johnson will not be fined another time. Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it wouldn't be able to make payments with the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and political crisis. Authorities warn that inflation may hit 40%. And McDonald's didn't have to look far to find a buyer for its operations in Russia. The existing licensee has agreed to buy the entire portfolio and operate the restaurants under a new brand. Earlier this week, McDonald's became the latest company to announce it would pull out of Russia in the wake of the invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
There's clearly elevated risk for things going into recession. And then inflation, it's high. We have it coming down over the forecast period, but it's not going to be low. It's not going to be back to the 2% target anytime soon.
Seth Carpenter, Morgan Stanley, really good to speak to him yesterday. We are all recalibrating here this morning. Negative 400 on Dow futures have modestly improved to a negative 327 now. SPX negative 41. The VIX was out two big figures. A little bit of improvement there. But Lisa, very quickly here, yields have come in with some of the economic data this morning.
People are pricing in a slowdown increasingly, and you're seeing that finally with the bonds getting a bid. I do wonder, though, how much this is baking in the determination of a Federal Reserve to curb inflation, to get it under control, Tom.
That will be part of the parlor debate here. We're going to continue it forward and welcome all of you on radio or television. This should be a 3-hour discussion. His ability in our international relations linked to our economy is formidable with his work at Goldman Sachs International for years. Robert Hormats joins us now with Tiedemann Advisor and, of course, his service to the nation in the State Department. Ambassador Hormats, I want to cut to the chase right now. I am hearing in every interview we will see a defense build-out by Germany. We will see a defense build-out by the United States of America. The president waltzes off to the Pacific Rim. What do we need to rebuild in the Pacific to show the flag in an appropriate manner?
Well, two things. One, I'm glad he's doing this now because I think there was a feeling in the Pacific, in some countries at least, that we were so preoccupied with Ukraine and Europe that we had more or less forgotten about the Pacific. This trip will demonstrate that we have not forgotten and that we realize that it's important. Second, he's got to get this set of alliances organized. There's been a lot of talk about cooperation, coordination, but there really hasn't been much progress on trade. The cooperation between the United States, Japan, Australia, New Zealand are all of these are important, and he has got to demonstrate that this is a sustainable alliance.
Right.
Pulling out of TPP was one of the worst possible things we could have done, because it showed not only a trade set of actions that was pulling back,
right,
but it showed that we really were not committed to a sustained relationship.
Ambassador, I want to get through this quickly because Lisa's got some really important questions away from this. This is your wheelhouse. All Republicans and Democrats are against TPP. My guess is they're against Indo-Pacific. Let's go granular to the reported victory of Marcos Jr. in the Philippines and what we do at Subic Bay and at Clark. How do we shift our modern behavior back to what you and I knew in our youth?
This is a critically important point. The way to look at Asia is there are two island chains. One is the one that's very close to China. The Chinese really have increased their domination over that with their small islands and their new Air Force bases that they put in. We have to demonstrate that we have credibility in that so-called second island chain, which is the Philippines, which is the Marianas, Guam, and Australia, New Zealand. We have to show that we are a strong presence there. And working with the Philippines, which is critically important. It was in World War II, it is now, and that's going to be, I think, extremely important to demonstrate that we can work. Important to demonstrate that we can work with young Marcos and develop our base structure, which was, as you know, virtually eliminated.
Bob, how optimistic are you that the political noise will be able to dovetail the national security issues of shifting around some trade partnerships at a time when inflation is very much at the forefront and people are more concerned about how quickly prices are rising as a result, in part at least, for some of the supply chain disruptions and realignments?
A very good point. I mean, the president's in a difficult spot. On one hand, it is clear that a lot of the tariffs that we've imposed on China do contribute. They're not the main contributing factor, but they do contribute to higher prices in the United States. And yet, if the president were to appear to be weak on that, it would look like he was weak on China. The priority here, it seems to me, is to deal with the inflationary issues. We can demonstrate that we're still resolute on China by strengthening our alliances in the region, which gives the president more flexibility to lower some of the tariffs on China, which really have not had any impact on China anyway, but certainly have had an impact on prices in certain sectors in the United States. So if he's tough enough and firm enough in building our alliances, it gives him a little more wiggle room to take action to reduce tariffs on certain Chinese items. And he needs to develop these trade relationships that we threw away when we got out of TPP. He's got to resurrect those and make sure that we don't just talk about them, that we have a firm and sustained program of trade cooperation with these countries in the Indo-Pacific.
Bob, just real quick here, we just have a little bit of time left. What grade would you give this administration in terms of reaffirming some of these alliances?
I give them very high marks. I think the fact the president now, in the middle of what's going on in Europe, is making a major trip to Asia is going to be very important. There's going to be a G20 meeting coming up. Whether he goes is not clear, but I think that anything he can do to demonstrate with these friends and allies in the region that we're back and credible is important. The one thing he also has to do is make sure that he can get bipartisan support for sustaining this, because a lot of these countries say, well, Biden's going out there doing this, making this good trip, but if the House flips and if you get another administration a couple of years from now, that could pull back from our commitment to alliances in the region. So we have to show, A, not only that we're doing this and we're and we're firm in doing it, but B, this is a sustainable proposition.
Robert
And
Hormats.
C, we've got to figure out how to deal with the Chinese issues that really matters.
Right.
These tariffs really have no real impact on China. There has to be other stuff, which is particularly intellectual property, trade secrets, and a wide range of other.
Ambassador, I don't mean to interrupt. We are out of time. We will continue this discussion. Robert Hormats are particularly strong on the Pacific Rim with Tiedemann Advisors. Lisa, this is an arch conundrum, and all I can think of is the British phrase OBE, or overcome by events. That's the only way this massive tension between international relations experts and the agreed upon Republican-Democrat resistance in Congress. It's one of the few real certitudes we have going on right now.
Yeah, a certitude amid a sea of uncertainty. And right now, ahead of the open, 30 minutes to go, I will say, I am just watching that bond stock relationship reassert itself as people get increasingly gloomy about how overcome by events turns into something that is a pendulum of gloom.
Can we agree it's a toxic brew?
I was talking specifics, but you know, you can have your toxic brew.
The Bramble can capture the toxic brew. Stay with us. Seriously, Market Tumall on radio, on television. Good morning.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What a messy market this is. Live from New York City this morning. Good morning, good morning. Your equity market down another 1%. Some negative follow through from a brutal session yesterday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the equity rout intensifying.
The market is, it's trying to find a bottom in here.
This has been a valuation re-rating.
We're starting to see inflationary pressures really affect the earnings of companies.
We have proper kind of recessionary pricing coming through.
We're pricing in a near-death experience where everyone frets, worries very deeply.
Over the summer, the S&P could touch down to around about 3,600.
We're seeing a lot of headwinds.
Notably lower growth, and we're going to see frustratingly high inflation.
The market, as I see it, is divided into two camps.
It started out as an inflation scare.
One who believes inflation is out of control, Deutsche Bank and others.
Then it became a growth scare as well.
The second who are very worried about recession.
There's a lot of pieces moving around here.
We still have time in this bear market.
Joining us now to discuss, Principal Seema Shah, Richard Bernstein of RP Advisors. Seema, first to you. Just what are we pricing in here?
It's an interesting one. The way that the market is reacting is as if there's a recession coming. But then when you hear from analysts talking about potentially a Fed put coming, then surely that risk of recession is off the table. We have a slightly different view to that.
What is your view on it?
Well, look, until yesterday, I think that our key view is that, we've clearly had very, very weak markets. What we would have anticipated is a bit of a stabilization in the market because the economy is still relatively robust and you still have positive earnings growth. And then we would have said this is the time to go risk on, but at least be neutral. And then in preparation for losses, maybe into next year as recession fears really come to the forefront. But I have to say, yesterday really stopped us in the tracks with the news from Target and Walmart. I think we have to really take consideration of that, of potential weakness from consumers are already starting to come through.
Richard, we've gone from seemingly an inflation shock to a rate shock and now a growth shock. Is that what this is?
I think to some extent you're absolutely right, and I think Seema's right about the growth side of things. But I think we have to remember that the number one issue here is a re-rating of the market, right? We effectively had a bubble in long duration assets. That bubble is now deflating. And on top of it, the Fed is now going next month to start extricating themselves from the long end of the market. So we had a bubble in long duration assets. That bubble is now deflating. What you're finding is short duration assets, things like energy, are actually up this month. So I don't think it's purely a growth scare, but certainly long duration assets are taking on the chin right now.
Richard, you've got a different view on the Fed as well. A lot of people would come on the show and they'd say, this Fed is so hawkish, and you say the following: you are what your Fed fund says you are. Can you build on that?
Right. So I find it actually quite curious that people think the Fed is so hawkish when the real Fed funds rate, the Fed funds rate less inflation, the real Fed funds rate is basically the most negative it has ever been in history, right? It's about -7, -7.5 right now, regardless of what measure of inflation you might use. And every recession in the last 50 years has been preceded by a positive real Fed funds rate. Now we have the most negative one in history. It's hard to argue that the Fed is even trying to slow the economy, let alone slow inflation. I mean, yeah, it's like shooting elephants with a pea shooter. They're hunting, but how effective are they going to be?
So, Richard, with that in mind, walk me through what you do expect. Hard landing, soft landing, something in between. Just listening to you there, a lot of people might assume that you think the Fed hasn't even started, it's got to go a whole lot further, and there's more pain ahead. Do you have a more nuanced view than that?
I think, Jonathan, the way I would describe it is I don't think a recession is imminent. I think that eventually we will have one because the Fed will panic at some point and they'll likely over-tighten. But the odds of that happening in the next several months or even this year seems low to me. And, Jonathan, if we're going to have a recession, this is going to be the most well-forecasted recession in my career. Usually recessions surprise people. They bite people in the tush.
Sure.
It's not like people are forecasting.
Okay, I hear you. we've been talking about it all the time for the last 3 months. We've been talking about inflation for the last 12 months. And Seema, like Richard, I sat here and thought, okay, this is a well-understood story. And like you, I saw those numbers from Target yesterday, a confused C-suite there at Walmart, a stock down by 25% on Target, a move we haven't seen since 1987. And Seema, I thought, okay, well, it might have been well understood, but how well priced was it? And clearly not very well priced at all.
Yeah, I would agree. And that seems like it's really been a feature of the market for so long. Just thinking about inflation, the market, the Fed, everyone believing it's transitory. And, clearly that has been proved completely wrong. And similarly with the Fed, I do wonder if the market has, it moved a little bit too high up, maybe 3 or 4 weeks ago. And now with this idea about a Fed put there, once again, you're ignoring the inflation picture.
So, Seema, let's talk about downside. Barclays out this morning saying risk firmly tilted to the downside. HSBC out this morning saying the growth risk is here right now. It's not next year, it's right now. Deutsche Bank saying right now we're at the recession crossroads. This is what Binky Chada had to say for the near-term call. I'll get to the base case for the long-term later. The near-term, with the cycle late and the Fed's guidance to a rate hiking cycle that ended in recession 73% of the time, we look for the market to price in a full average recession decline of 24%. He's looking for 3650 on the S&P in the near term. Seema, your thoughts on that?
Yeah, so look, actually, we're not too different on that. So our baseline is recession late 2023, early 2024. And as soon as the market really starts sniffing that out and really puts to bed this idea that there's going to be a Fed put anytime soon, then I think there could be further losses. There's always going to be opportunities within equities, but from the index level, I think that's possible.
Can't keep up with this market. About 24 minutes out, not hours, from the opening bell. We're down by about 1% on the S&P 500. On the Nasdaq, down 0.9%. No, Kayleen, 24 minutes feels like 24 hours in this market sometimes.
Yeah, it absolutely does, because it's one of those markets, John, in which the price action has been absolutely brutal recently. Of course, yesterday, the worst day for the S&P 500 since June of 2020, but really just one in a series of big down days we have seen that have taken the index down about 18% from its record high in January. We're getting very close to a technical bear market. Right now, S&P futures are trading at 38.85. A bear market would be at 38.37. So we're within about 50 points. And when you look beneath the surface of the index, there actually are 4 sectors: financials, tech, communication services, and discretionary, that already are in bear markets, down more than 20% from their peaks, 33% in the case of discretionary, which feeds back into that Target story that you were mentioning. But all 11 sectors are off from their record highs. Even energy, which is where you have been able to get some gain in the equity market on a year-to-date basis, that was not immune from yesterday's selling, with only 8 stocks in the entire S&P 500 up on the day yesterday. That is how broad-based the selling was. As for the reason why, as you three have just been discussing, it's all about growth concerns now. The idea that central banks are hiking into weakness. Potentially there's a recession coming in the not-so-distant future. David Kostin over at Goldman Sachs doesn't think a recession is inevitable. Well, when he crunched the numbers, he came up with a similar story as Binky Chada. 3650 is where you would get if you saw the average 24% decline, as we've seen in the 12 recessions since World War II, or the median, rather. The average brings you down about 30%. That could take us all the way down to 3360, John.
Katie, thank you. I see this right across the street right now on Wall Street, just pouring through all the research. There is this near-term call, super cautious, then this long-term call, we get better. We have this relief rally into year-end. You see with Deutsche Bank too, we've talked about that downside in the near term at 3650. Binky Chada over at Deutsche Bank still has a year-end price target of 4750. The median price target on Wall Street right now is 4800. I see it time and time again. In the near term, this is from Goldman. 3-month forecast, 4K. We expected gains likely coming later in the year, but ultimately in the near term, this is what they say. Higher equity prices in the near term would ease financial conditions. So ultimately, any easing of financial conditions would be seen by the Fed perhaps as an unwarranted loosening of financial conditions. HSBC, you'll see a similar theme here. Look at the cautiousness in the near term, and then look at this relief rally they look for in the long term. They said the following: the next couple of months, we'll see the growth shock dominating the real rate shock. We stay defensive with an underweight in equities and high yield credit. Their forecast for the S&P, 4450. The idea we get this relief rally into year end. Richard, I want to come to you on this. This near-term call on Wall Street right now, that things are bad, it's going to be a rough summer, put together with this second half call that you get a relief rally and we end up somewhere close to 4800. Does that make sense to you?
Well, I think it's normal. I'm not sure it makes sense, using your term, Jonathan. I think, look, long-term sentiment is always kind of based on three different characteristics when you start getting a bear market. Number one, whether it's inflation or the market right now, the initial thing was it's temporary or transitory. Then you get people talking about it's peaking or it potentially is bottoming. You'll know it's over when people say it will never end. When people attach permanence to a bear market, when people attach permanence to bad economic data, that's when you should start, your contrarian antenna should start wiggling. Right now, I would say this is actually quite normal. I don't see it as being much of a signal other than that normal progression of sentiment.
Would you see it as a signal that perhaps we just haven't seen capitulation, Richard, or do you think the South side is completely divorced from what's happening on the buy side, what's happening in this market?
Oh, I don't think you've seen capitulation at all, Jonathan. I mean, how many times have we heard people looking for, quote, entry points back into technology? I don't think you've seen capitulation at all.
What do you think it looks like? How would you gauge it?
Well, if you just look at NASDAQ's retracement now, NASDAQ's down roughly 29-30% from its peak. I think if you look at 2000, I think NASDAQ went down about 75% from its peak or something like that. So, this would say we're in the midst of it. Granted, I'm using a sample size of 1. I understand that, but
you're also using the most extreme example too, Richard. But carry on.
Yeah, of course. But if that's your example, then you'd have to say we're in the midst of it. Right? We're in the middle.
Seema, what's your take on that?
So I don't want to use that example as a terrifying one. Look, I think the market has to come to terms with what's really coming. I don't think we've ever had as clear long-term vision as we have now. I think that there's a risk that some of that long-term vision of knowing that there's a really significant slowdown coming within the next 18 to 24 months can cloud some of that near-term view. But I think we also have to be respectful of the data that's coming in. Some of the earnings figures are concerning, and it's telling us that maybe the consumer is struggling a little bit more than we expected. And some of the equity markets, some of the various sectors are going to struggle even more. So I think we could see further losses coming. But I have to say that to the end of the year, I think we see more of a range bound. We're going to see a fair amount of volatility, but we're going to see equity markets moving up from good data, down on some pretty bad data. And then you get to the end of the year, and then I think that's when the pain really starts to begin.
Seema, just on the retailers and the numbers we saw recently, Target down 25% yesterday, Dollar Tree down 14.5%, Costco down 12.5%, Dollar General down by more than 11%. It's easy to run away with the bearish theme. I've got to ask a different question, just to kind of probe your thinking on this matter. I haven't heard the same thing from the airlines. If I listen to the airlines about the consumer right now, they tell me the consumer's strong, they're able to put up prices and pass on higher costs without much pushback. Seema, is this a change in the product mix? Is this a change in consumer behavior, or is it a real sign of consumer weakness?
No, so the interesting thing with the airlines, I think this is more of one of those post-pandemic themes where we are seeing that rush for airlines. We can see it just, talking to anyone on the street. Everyone is really wanting to go on holiday after the first time in 2 years or so. So I think that this is one of the short-term post-pandemic trends, and you get into 2023 and we see some normalization of that. And you see the economic growth behavior start to weigh on things like airlines. This is a good time for airlines, but that is a post-pandemic trend rather than a feature of economic strength.
Seema and Richard, sticking with us. We are about 17 minutes out from the opening bell. Equities do recover just a little bit. We're down 0.75% on the S&P. On the NASDAQ, we're down about 0.5%. Breaking down the movers, here's Abby.
Hey, John. Well, yes, futures are off the lows, but nonetheless, lots of laggards to taking a look at, starting off with the shares of Cisco Systems, a networking giant, plunging. This, of course, after the company yesterday slashed its current quarter revenue view to a negative 1% to down 5.5% from up 6%. So again, slashing the revenue view on China COVID lockdowns and the Ukraine war, encouragingly saying it doesn't have much to do with consumer demand, but nonetheless, not a great picture there. Kohl's down 6.1%, a very familiar story. Earnings, they missed by more than 80% on high costs, of course, lowering the outlook, and inventory up 40%. So the department store version of Kohl's Target and Walmart hitting Kohl's. Under Armour down almost 5%. This, of course, after the CEO yesterday walked away from the job after 2 years. Shares in free fall this year, down 60% basically from last year's peak. And then finally, breaking news moments ago, Harley-Davidson at session lows, pre-market lows down 9.9%. They are temporarily suspending shipments on a compliance concern. Taking a look at the company's statement, they are saying that out of an abundance of caution, based on information from a third-party supplier, they are suspending shipment of all vehicles for a 2-week period. Stock not liking it, John, down 9.9%.
Down close to 10%. Abby, thank you. Coming up on the program, passing the buck on record gas prices.
President Putin's actions are what is driving the price increase at the pump. The president is focused on doing everything in his power to address the Putin price hike.
That conversation up next.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The Federal Reserve is independent. We leave them to make their own policy decisions. We do not get involved in that, and nothing has changed on how we see the stock market. We do not. That's not something that we keep an eye on every day. So I'm not going to comment about that.
The White House shrugging off concerns about the equity rout and placing blame on Russia when it comes to the pain at the pump.
The reason why we have that challenge is Putin's decision to invade Ukraine and the implications of taking Russian supply of crude oil and natural gas, but also of Russian refinery capacity off of the global market.
Here's a stat for you. Gasoline prices now topping $4 a gallon in every single U.S. state for the first time ever. AMH down in D.C. for more. Morning, Anne-Marie.
Good morning, John. Well, today, House Democrats are going to be going after corporations. They have a plan that they're forging ahead, which goes after corporations for, quote, price gouging. And when you look at some of the text, this would give a power to stop the sale of consumer fuels at excessively, or unconscionably is what they call it, unconscionably excessive prices. Now, this is really just a broader narrative from this administration and Democrats on the Hill going after corporations, not just in oil and gas companies, but meat packing companies, saying that they are going after and taking advantage of the pandemic-era disruptions to lift consumer prices and make profits. Now, there is some polling out there that does show that consumers are annoyed with oil and gas companies who are raking in record profits. But when you talk to economists, especially those that even align themselves with the Democratic Party, they go back to something Secretary Janet Yellen said herself. Inflation is a matter of supply and demand, and many see little evidence that this is price gouging.
So, Anne-Marie, let's talk about refining capacity and the politics of that. It's easier to speak to the electorate sometime and just find the blame and just say, it's price gouging. It's hard to convey the complexities and nuances of what happens further downstream with refining.
Yeah, so there's two big problems right now when you look at the global oil market and what that means when you break that down into products, jet fuel, diesel, and obviously gasoline or petrol, wherever you are in the world. So first is the fact that there needs to be more oil in the world. And part of this, as Brian Deese, you heard, is exacerbated by what's happening with Russia. You're taking out a massive producer of commodities, most notably oil and gas. Then you have the fact that this refining capacity is very low. And we have been coming into this season, which is peak driving season in the United States, the summer months, with inventories of these products very low. So you have low inventories, and then refining capacity, the ability to turn that crude into actual products, is very, very low. And Jonathan, this has been an issue before the pandemic. Refineries have been shutting down. There's not a lot of investment in it. And the bottom line is you cannot fix this overnight. Building a new refinery, putting investment in it, that takes months, if not years.
Yep. AMH down in DC, Anne-Marie, thank you. Wealth destruction in the equity market, gas prices higher. It's a difficult moment to be in power, that's for sure. Difficult moment to be the consumer, even more so. Chris Harvey of Wells Fargo says this on the energy sector. The energy sector margins have improved sequentially in each of the past 5 quarters, while the overall market's margin trend has been flattish to down. That sector is up by more than 40% this year on the S&P. Seema Shah, it's a sector people still like. I want to understand, at some point, the cause of the pain, energy, becomes the victim of the solution. Energy gets hit by weaker demand. When does that happen?
Yeah, it's a really good point. And, you know, we, like most people, have really liked energy commodities within the real asset space as well. We have to start becoming a little bit more concerned that as we get that growth slowdown coming through, especially if you see the China slowdown really starting to gather pace, then I think that you could see that energy sector performance start to turn. I don't think we're there yet. As I said, I think that the pain starts at the end of this year, early 2023. So for now, I think we're okay, but it is definitely one to watch.
Richard, where are you taking risk right now? Where are you comfortable taking equity market risk?
Well, Jonathan, I'm going to take the opposite side of that on energy from what Seema just said. I think we think the energy sector is actually quite attractive. The energy sector right now is the #1 sector for dividend yield, higher than utilities, higher than REITs. It's the #1 sector for dividend yield. And here's the shocker, it is the #1 sector for 5-year projected earnings growth rate. So it's the #1 sector for yield, and it's the #1 sector for growth right now. In fact, that 5-year growth rate is almost double that of the tech sector. So growth investors just don't believe the numbers yet. They don't want to believe the numbers. But, you know, our attitude is take the data for what the data is. And why would we think that energy analysts are dumb and tech analysts are smart? But energy analysts have a tremendous 5-year forecast. So the energy sector, I think, is still a very attractive sector. The one thing that I don't think people are considering is, remember, China's been in a lockdown. Their energy demand has been muted. What's going to happen as they open up? Could we be looking at, you know, April, May, June, July of 2020 in China happening right now for them as they start opening up, which would increase demand, which would make prices go even higher. Final thing I just want to say, Jonathan, on this is I think the energy sector is the least understood sector in the entire marketplace. The notion that we are energy independent is completely wrong. And you mentioned this about refineries.
Yeah.
We can't refine our own shale oil here in the United States. That's all for export. But people don't realize that. So they think by drilling, we're going to solve the problem. It's refining that is the problem, not drilling. And as Seema pointed out, that takes years to build. It doesn't happen overnight.
Richard, you know, if you want to make someone look like a fool, ask them to forecast the price of crude 12 months out. No one's good at that. Richard Bernstein, Seema Shah, to the both of you, Thank you. Futures down about 0.8% on the S&P 500, slightly negative as well on the Nasdaq. The rout continues. Up next, the morning calls and later Coles cutting its profit forecast as another retailer falls victim to surging prices.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Away from the opening bell, equities negative. Here are your morning calls. First up, Morgan Stanley downgrading Under Armour to equal weight, seeing too much uncertainty following a surprise departure from the C-suite. Stifel downgrading Target to hold, pointing to weaker gross margins and a softer US consumer. And finally, Wedbush cutting its Tesla price target to 1K, expecting China lockdowns to weigh up on upcoming deliveries. A lot of barns, stables and closed doors and runaway horses in some of those calls. Dan Ives of Wedbush coming up.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
"24 seconds away from the opening bow this morning. Good morning to you all. We are negative once again. You're used to hearing that. We're down 0.9% on the S&P 500. On the Nasdaq, we're down about 0.6%. The good news is that we are well off session lows. The bad news is that we have some real negative follow-through from yesterday. Let's see opening bow, switch on the board and get to the bond market. That negative correlation between equities and bonds, it sticks. Equities lower, bonds up, yields heading south, down 10 basis points to 278.12. Keep saying this, but worth bearing in mind, 2 Mondays ago, 320 on a 10-year. Right now, 278. Euro finding some strength against the dollar. The dollar showing a whole lot of weakness in G10 against the Japanese yen and the Swissy. Euro dollar positive 0.75%, 105.44. And an ECB, judging by the accounts, that's ready to go soon on interest rates. Looking at crude, we're down 1.9%, 107.52 on WTI. We're about 30 seconds into this. Let's get you some movers. Here's Abby.
John, yesterday's carnage in retail continues this morning, led by department stores. This is one of the department stores has reported Kohl's plunging. This after they reported an earnings miss of 84%, not surprisingly, on the familiar theme of rising costs. They also cut the outlook. They have 40% increase in inventory, so perhaps some discounting ahead. So this is the department store version of both Walmart and Target. Macy's down 1.9%. They report next Thursday, probably some expectation that that could happen. Harley-Davidson, of course, out with news this hour that they are suspending shipment of vehicles for 2 weeks, an abundance of caution after a third-party supplier warned of a regulatory compliance issue. That stock down nearly 11%. And there is Kohl's again, but BJ's is actually bucking the trend. That stock is up, John. One retailer that beat earnings and revenues. They seem to be bucking the rising cost trend as gasoline helped out.
They are hard to find. It's hard to find those companies that are executing right now, given how quickly this economy is moving. Abby, thank you. We're about 2 minutes into this one. Your equity market is lower by 0.6%. Everything on my screen, every single sector industry group is negative. We've got consumer staples down a little more than 1%, down 1.2%. Industrials down 0.9. Energy down 0.8. Financials down by 0.75%, no doubt, not helped out by what's happening in the bond market. Big cap tech has been under pressure all year. Let's get to Ed Ludlow on the West Coast for more. Hey, Ed.
Yeah, good morning, John. We're down 0.3% on the Nasdaq 100, 0.2% down on Apple, slightly higher on Amazon after those two stocks in particular had declines of more than 5%. What we're seeing on your screen is mega cap adding to a 29% drop from the Nasdaq's peak back in November, and I'll remind you that that peak came 1.5 months before the S&P 500. In all the conversation I've been having of the last few days, we're trying to place this bear market and sell-off in the context of what's gone before, the dot-com bubble, the global financial crisis. The reality is, look at that bottom row, the current decline. We've shared almost $8 trillion of market cap. And if you think about the mega cap names we're talking about on a year-to-date basis, at least, your Apples, your Amazons, those that showed some resistance in the early parts of this sell-off because of their strong balance sheets and their ability to circumvent supply chain crunches, look at those year-to-date declines. And they account for almost $3 trillion of the sell-off that I was just talking for. The same story, rising bond yields, concerns about global growth. Difficulty here is where does it end? And we're still modestly lower on the Nasdaq 100, up now 0.2% on Apple.
Ed, stay close. I'll catch you within about 10 minutes' time to talk about some other things. I want to talk about Tesla just briefly with you. The stock is down by only 0.5%, but big Tesla bull. Dan Ives of Wedbush. She's going to be with us in about 10 minutes. He's cut his price target to 1K from 1,400. Let's be clear, that's still bullish based on where we are at 705.
Yes.
He said this, Ed, the success of the China story on both the supply and demand side are the linchpins to our long-term bull thesis. That said, the reality is the current Shanghai lockdowns have been an epic disaster. You've been covering it. What are you hearing?
Yeah, I think when you strip out all the noise around Elon Musk and Tesla, you go to China. It's been the engine room of growth. It's been their blueprint for being able to scale production globally, because we're so impressed by what we've seen in Austin and Berlin, we forget the pace at which they built that Shanghai factory and how quickly they went to market. And we remember one other thing about China, John. There are many more players there, domestic brand names that Tesla competes against successfully. So now that we recognize the problems, we start to have concern, and that seems to be what Dan Ives is talking about here.
Ed, thank you, buddy. I'll catch up with you in about 10 minutes. Catching up with Dan as well. 4 minutes into this, we're just about unchanged on the NASDAQ. We're doing okay for now. No idea if any of this sticks. On the S&P 500, we're down about 0.4%. A real lack of confidence, conditioned by the price action recently. Target, a great example of that. Go through the retailers. It was Walmart, then it was Target, now it's Kohl's. All three of them cutting their profit forecasts as surging prices eat into margins. The CEO saying the following: sales considerably weakened in April as we encountered macro headwinds related to lapping last year's stimulus and an inflationary consumer environment. Kaylee's back with us for more. Hey, Kaylee.
Hey, John. Well, we've been talking about margins for so long now, and up until recently, they've held in. Companies were seeing such strong demand that they were able to pass on the higher input costs they were facing to the end consumer. But it feels like, at least in some sectors, that story is starting to change as consumers have to pay more for basic necessities like food and gas. That is hitting discretionary spending. What's interesting, though, is that while that should raise concerns about profits going forward, you're still seeing earning expectations climbing. That's the blue line here on this chart, and the white line, of course, the performance of the S&P 500. So yes, John, we've seen multiples come in, but that's because the numerator price is moving, not because of the denominator. And of course, indeed, stock prices have moved in dramatic fashion. We're down about 18% year to date on the S&P 500, down about that much as well from its record high. We're within about 70 points or so of bear market territory, and most strategists didn't really see this one coming. Back in January, they expected the S&P would add about 5% this year to around about 5,000, actually. We're now dancing around 3,900, so a classic game of catch-up is happening once again. The latest to capitulate, at least in some sense, HSBC 4450, the new target, and Binky Chadha, the big bull over at Deutsche Bank, cuts his target down to 4750. That is in his base case scenario in which there is no imminent recession, but he says if one does indeed occur, John, we could go down to 3650.
Katie, thank you. Thank you very much. In fairness to Binky, I was reading that note yesterday evening, near term 3650, and then he basically said it's all recession dependent from there. What happens? The downside, the upside, the base case. There's the base case year end right now. What do you do with it? I keep asking that question. What on earth do you do with a base case year end price target on Wall Street, a median of 4,800, when you're seeing this mess unfold right before your eyes? That's the story in equity. I want to talk about credit too. High yield spreads are just starting to break out in a way that gets your attention. 472 basis points right now. We had an offering yesterday from a company that I know you all know, Carnival. Carnival offered $1 billion of refinancing. The pricing discussions were in a range of 1025 to 1050. Olivia Raymond here at Bloomberg reporting on this. If you go back 7 months, that same company offering that debt, they were managing to upside the offering and the yield was just 6%. That's a monster change. So let's talk about what's happening in corporate credit with Invesco's Matt Brill. Matt, I want to start in high yield and work our way up in quality to investment grade. What's the signal from that, Matt? Just the change in 6-7 months.
Hey, good morning, Jonathan. Yeah, what's telling you is that it's getting harder and harder to borrow money, but the markets are open, and that's the key. The fact that they got the deal done yesterday is a huge positive, in my opinion. Had they not, that would be the story. Yes, they paid up for it, 10.5% to 8 non-call 3. So after 3 years, if they're doing better, they can buy it back. They can call it back. So they're buying themselves insurance. It's a lot more expensive than it cost just 7 months ago, though.
And Matt, that's the big difference between now and December 2018. In December 2018, the market wasn't open for this. Is that why you think the Fed's not going to turn around and go the other way anytime soon?
Yeah, so things are functioning. The Fed's going to do 50 in June. They'll do another 50 in July, and then hopefully probably 25, the rest of the year after that. There's talk about whether there's a Fed put. There's not a Fed put coming anytime soon. But the Fed is looking at what our market is doing and trying to figure out, is it being rational? And it is. People are paying up to borrow right now, and as people that lend money, we're not enjoying this, but we're actually, for once, in the driver's seat. We're actually having pricing power. We're dictating terms of the deals. We're putting covenants in deals that weren't happening before. So the Fed is viewing that as rational, as healthy. The Fed's also going to see that the margins are going to be shrinking and that consumers are being rational as well. Consumers are not continuing to pay up and up for things. So you're going to start to see inflation come off. At the same time, the Fed is going to back away a little bit. And it's not a Fed put. It's just the Fed seeing that things are calming down in terms of growth and inflation.
Matt, with that in mind, I just wonder how much upside do you think there is on yields in some of these markets at the moment? We've seen this market, the credit market, adjust to higher interest rates. Certain parts of it have been battered. Only recently have we started to see credit spreads break out in a more material way. Matt, what do you make of that development, and how far do you think that can go?
Yeah, just to put it in perspective, double B high yield really underperformed all year long versus triple C high yield. So everybody wanted to buy the dirtiest bonds because the economy was fine and it was an interest rate risk that you had to worry about, not credit risk. And that switched. So I think that has changed in the last 3 weeks. We've also seen correlation, as you stated a few minutes ago, negative correlation now, where we're getting flight to quality on days like today, where we're not losing money in bonds and stocks for once on the year. So that's kind of normal. We're getting back to those to normal bond markets. I look at overall valuations in high yield. They look pretty attractive to me, but I'd stay up in quality there. I look at investment grade. The one metric we're looking at is 3 to 5 year corporates. 3 to 5 year corporates versus S&P 500 dividend yield. You're now getting about 4.1% in 3 to 5 year corporates versus 1.5 to 1.6% in S&P 500 dividend yields. They were basically in line for the last 3 to 5 years. All of a sudden, you're picking 200, 250 basis points to buy bonds versus stocks. That's a pretty decent trade, in our opinion, that hadn't existed for a long time.
Matt, you offered two things there, a duration story and a quality story, a preference, a duration preference, a quality preference. What's your sector preference?
So the sectors, you got to stay away from consumer cyclicals right now. So first off, that's very difficult. Energy has always been the area that you've been the most nervous about. Actually looks pretty good. And then the cheapest area to me that's just being indiscriminately sold right now is financials. So we saw Citibank. They came with a 10-year bond just yesterday at around 195 basis points. Earlier in the year, that would have been a little bit over 100 basis points over Treasury. So you're getting near 5% to buy a company. I'm not recommending Citi, but I'm just using it as a reference.
Sure.
That Warren Buffett's issue is investing in these types of companies, and yet their bonds are getting crushed. So I think that's a great opportunity.
Matt, I'll keep you out of trouble. No single names, don't worry. Just a final one here. I'll mention the single name, Carnival. It was a head scratcher for some people. They came in and did the refinancing at the time they did it, at the yield they did it right now. My question to you is the maturity wall. Just a little bit more on supply if you can. Is there a maturity wall out there, Matt, and how far out is it? When do you really need to start to get concerned about these companies needing to come to market?
So I'm glad you asked that, because it actually makes me sleep better at night knowing there is no maturity wall. So I'll talk a little bit about investment grade specifically, though. There's 2% of the investment grade market that is coming due in 2022. There's 5% in 2023, and there's 5% in 2024. The profile is very similar in high yield. There's no maturity wall. Companies do not have to panic right now. If they can get access to the market, they should go ahead and increase their liquidity a little bit, continue to term out securities. But this is not 2008, 2009, and it's not the end of 2018, which certainly makes me feel a lot better.
Matt, there you go. Helping people sleep well at night. We appreciate it. Matt Brill, thank you, buddy. As always, equities are just about positive on the NASDAQ by 0.2%. 12 minutes in on the S&P, just about negative by 1/3%. Certainly better than where we were a couple of hours ago. Coming up, the pain in big cap tech stocks making its way to China.
Direct investment flows into China last year were super strong. This year, I suspect they're probably going to be somewhat weaker.
That story, and Dan Ives saying China lockdowns will weigh on Tesla's June deliveries. He cuts his price target. The big Tesla bull, still bullish, but less so. That's next. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
China still wants to encourage investment inflow. So I don't think we're going to see a big shift. I think China will try to keep open its ports and logistical mechanism. It's obviously struggled to do so during the COVID lockdowns. It's going to be a major challenge for the economy and to entice foreign businesses.
Tencent leading the sell-off in Chinese tech, the company warning that Beijing's crackdown will not end soon. On the West Coast, let's get to Ed Ludlow for more. Morning, Ed.
Yeah, good morning, John. We saw broad selling across Hong Kong and Chinese-listed technology stocks. You know, this is cause and effect. Weak corporate earnings with a backdrop of a gloomy macro picture. Alibaba and Tencent, the biggest drags on the Hang Seng index. Tencent executives are warning essentially that despite signals from policymakers that they will ease on their regulatory crackdown on the technology sector, it's just not going to happen right away. It's not going to happen anytime soon. You look at the revenue growth of this company, which they reported at the same time, it has disappeared, evaporated, vanished. That is a chart which will worry some people, especially the right-hand side of it, right, where we've very steadily decreased in the top-line growth we're seeing from this company. The backdrop, lockdowns in China, a disrupted supply chain. But this is a global story, because we're seeing the sell-off in Chinese and Hong Kong-listed technology shares replicated in both Europe and the United States. And you asked, John, what is the common denominator? And everything that I'm reading says that China lockdowns and the supply chain is the common denominator here.
Ed Ludlow, thank you. Dan Ives of Wedbush is on board. He's cut his price target on Tesla from 1,400 to 1,000. Here's the quote. The reality is the current Shanghai lockdowns have been an epic disaster. We expect to see modest softness in deliveries this quarter with a slower growth trajectory in the key China region into the second half. Dan Ives joins us right now for more. Dan, let's start here. We only spoke a few days ago. What's changed?
Yeah, I mean, look, our checks, over the last week, especially even over the last 48 hours, it's just not showing the improvement that we wanted to see, which essentially means in China, going to be a pretty big disappointment, not just on deliveries, but production. And the zero COVID issues, have really been a Category 5 storm for Tesla here. And look, we're not just going to cut the price target just to cut it. I mean, fundamentally, there's a change. I think it's a new reality for Tesla in China. And that's why we're cutting numbers and price target accordingly. Still bullish.
Well, still bullish, Dan. I mean, so let me jump in on that. On 1,000, given we're at 695 right now, let's talk about reality. How divorced from reality is your price target at 1,000 from the stock right now at 695?
It's all how you view it. If you think that the zero COVID issues continue for
year, 2 year, then obviously it's unrealistic. We believe this is going to be something that will start to navigate smoother waters as we get into the second half of the year. Production will ramp in Giga Shanghai. You'll start to see deliveries start to significantly ramp second half of the year. And I think that starts to happen. Then the Tesla growth story, again, starts to take hold. But, this is rose-colored glasses right now. In the June quarter, in our opinion, given what we see in China, I call it it looks like an epic disaster coming out of China.
Dan, how would you know if you're wrong about the future, though? What would tell you? And what would tell you that would get you out in front of this in a way that you weren't this time around?
I mean, if we go into June, July, and we're in the same situation, it's start, go, supply chain issues, that lockdown continues, and ultimately you do not see the ramp, then all of a sudden you could look at deliveries for the year that could be off another 100, 200K, because China, as Ed talked about, it's 40% deliveries, and it's a big part of the production and the most profitable. And then, of course, the sideshow, the circus show with Musk and Twitter. Yeah, it's been a black eye for Musk, and just I think the way that this has been handled has really been unconscionable in my opinion.
Dan, you called it a circus. Let's talk about this tweet. It came out yesterday from Elon Musk. I want your interpretation of it. In the past, I voted Democrat because they were mostly the kindness party, but they have become the party of division and hate, so I can no longer support them and will vote Republican. Now watch their dirty tricks campaign against me unfold. Dan, you're an analyst. I'm just a guy hosting a market show. We don't have to talk about the politics of this because I've got no idea what that means. But Dan, I do want to talk about the regulatory threat that this individual might face. How big do you think it is?
Look, I mean, it goes back to the Twitter situation in the beginning. It's been a disaster from the beginning, and he just continues to add fuel to the fire. And right now, at least from Tesla's shareholders, it's like, as the plane's crashing, you're worried about salted or unsalted peanuts. And I think that's the frustration, because you right now want Musk dialed into the Tesla ecosystem, navigate what we see in China, as well as overall production issues. These sideshows, look, I think from an investor perspective, in a white knuckle market, it's exactly what you don't want to see. It just adds more news, and like you said, even political blowback in what's just been, I think almost a tornado-like situation.
Dan, just a final question, and work with me on this. Often I'll speak to people on the buy side that become married to a stock. They're conditioned by it because it's treated them well over a series of years. They get the gains, and then they start to get punished by it, and things start to go wrong, and they just don't know how to get out of that name, and the losses build up. They become married to it. Dan, as an analyst, is there a risk that people who have been bullish this name for so long just become married to it? And how do you make sure that you don't become one of those guys?
Yeah, look, I think sometimes, to your point, there becomes an emotional attachment, whether it's bullish or bearish, right, on both sides. And that's why I think you can't wear the rose-colored glasses. You got to ultimately call, I guess, and it comes down to fundamentals. That's why China's story continues. Tesla is a stock, given electric vehicles, massive transformation. I think the stock will continue to move much higher. However, if all of a sudden it starts to falter, you cannot just expect that the past is ultimately a prediction of the future. And no doubt, I think that's right now, it's a fork in the road situation. As we go into the Tesla story, especially given Musk, I think right now there's been some almost semi-permanent taints on the story because of the way that this soap opera / circus show has turned out.
Dan, we'll keep talking about it. The stock, the company, the leadership, and as you say, the circus show. Dan Ives there on Tesla right now, 698. He's cut his price target from 1,400 to 1,698 and down about 1.8% on the session. Up next on the program from New York City, your trading diary for our audience worldwide, your equity market. Certainly not as bad as it was a few hours ago. And then we turn lower again. On the S&P, we're down by more than 1%. On the NASDAQ, we're down by 0.8%. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
About 30 minutes ago on this program, I said if you want to make a fool out of someone, ask them to predict the crude price 12 months out. Another way of doing that is asking someone to predict this equity market 5 minutes out. We are all over the place. We were briefly positive on the NASDAQ, now negative about 0.5%. On the S&P, we're down 0.9%. That's the price action. Here's the trading diary. President Biden speaking at 10:30 Eastern. The president then heading to Asia for the weekend. Look out for some headlines from that. Retail earnings continue with Ross Stores after the close. Plus, Minneapolis Fed President Neil Kashkari speaking at 4 p.m. Eastern Time. The Fed speak continues with Bostic and Esther George, plus the FOMC minutes coming up next Wednesday. From New York City for our audience worldwide, this was the countdown to the open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes,